Hello champs, hope you all are doing amazing. In this video, let's discuss September 2025 CA Foundation accounting question paper along with ICAI suggested answers. Meanwhile, I've also gone through the examiner's comment wherein I can advise you while we come across the respective questions on what was the expectation from the examiner and what was the mistakes committed by students. This will definitely help you in your presentation and preparation as well, guys. So let's begin the discussion with the strong committed mindset. Question number 1, part A will always be true or false, wherein you have to answer by quoting the statement as true or false along with the relevant reasons. So let's begin this. First one, the materiality depends only upon the amount of the item and not upon the size of the business, nature and level of information, level of the person making the decision. The given statement is clearly emphasizing that materiality concept is purely dependent upon the amount of the item. So this is not correct. So hence the given statement will be false. What will be our reasons? Here you have to use as a keyword which says that significant elements having the economic effect will impact the concept of materiality, because materiality is basically talking about what would be the relevant information for the purpose of disclosure in the financial statements. So this keyword I will also emphasize while we discuss the respective answers. I will show you, so then you can come across the respective word. Next point, next one. While preparing the income and expenditure account as per accrual concept, the income and expenditure is considered in the period in which actual receipts and actual payments are made. First of all, income and expenditure is made on accrual basis. The given statement here is emphasizing on recording the transaction, that is receipts and payments on cash basis. So the given statement here is false. Income and expenditure and exclusively accrual concept talks about occurrence of transactions and events. Based on that, we will make the recording. Whereas what is presented here is as per the cash basis of accounting. Hence, the given statement is false. Next, profit sharing ratio and capital contribution ratio need not be same. Yes, as per partnership agreements, both ratios need not be same. So the given statement is true. Now, profit sharing ratio is purely dependent upon the mutual agreement between partners, whereas the capital contribution ratio, nothing will be specific because it purely attributable to the amount they invest in the form of capital. So hence the given statement is true. Depreciation is not provided in the financial year when the entity incurs loss. The given statement is false. You have to use a specific statement here. Depreciation is a charge against profit. What does charge against profit here means? It is nothing but you will record or you will provide for the item even if there is loss. So it is called charge against profit. There is one more specification called as appropriation of profit, wherein we provide for certain items only when there is profit. Depreciation will fall under the category of charge against profit. Hence, the given statement here is false. Next, the concept that helps in keeping business affairs free from the influence of the personal affairs of the owner is known as the matching concept. Whenever we come across the affairs talking between the business and the owner, it directly connects us to which concept? Business entity concepts. So hence the given statement here is false. So here they are specifying that this is as per matching concept, hence the given statement is false. Next, a company cannot issue equity shares at discount to general public. Yes, as per the Companies Act, that is to be more specific, as per section 53 of Companies Act 2013, you cannot issue shares at discount to the public. So the given statement here is true. So let's observe what is the relevant reasons and answers as per the suggested answer given. First statement, they are talking about materiality concept. So as per materiality principle, all the items, observe here, having significant economic effect on the business should be disclosed in the financial statement. This is the keyword which will observe your elements of what you have to quote in the answers. Next, false. Again, While preparing the income and expenditure as per accrual concept, the items of revenue pertaining to the current period are included and not the actual receipts and payments. So you will emphasize more about the items related to current period of account because that is what the accrual concept proposes as well. Next was about profit sharing ratio and capital contribution ratio. See, the profit sharing can be different from that of capital contributed, and it is not necessary that the partner contributing more capital should have a higher profit sharing ratio because it purely depends on the mutual agreement. Observe the last line. Profit sharing ratio is determined by mutual agreement among the partners. This line becomes important to utilize in your reasons. Next point, depreciation will not be provided in case of there is any loss. That was the statement. So as I explained while we were discussing, depreciation is a charge against profit and it is not an appropriation of profit. Therefore it has to be provided even in case of loss in a financial year. Next point, it was about the matching concept wherein they were discussing about the affairs between business and owners. So the concept that helps in keeping business affairs free from influence of the personal affairs is called business entity, and matching concept specifies that all expenses matched with the revenue is taken into consideration. Here they're just explaining what is business entity concept all about and what does matching concept proposes. Last was issue of shares at discount to the public is not allowed as per Companies Act. So the given statement was true as I specified there. According to section 53 of the Companies Act 2013, a company cannot issue shares at discount except in case of issue of sweat equity shares, that is issued to employees and directors. Thus, any issue of shares at discount shall be void. So these are the respective reasons given as per the suggested answer. As per the examiner's comment, the examiner are clearly pointed out that points where the students would give the reasons. They've quoted whether it is true or false rightly, but they have missed their marks in quoting the valid, relevant reasons with respect to the concept of materiality, and then the other points were still okay. So, as we have discussed, please make sure that you make use of the respective words as it is in order to not lose marks in reasons, because this is a sweet spot where you can secure 12 marks easily. I hope this was clear. Moving on to the next part of the question, explain the generally accepted valuation principles. So it is a straightforward questions asked for 4 marks. Generally accepted valuation principles, one of the important theoretical aspects. What are the 4 aspects where we use as the measurement of valuation principles? One is historical cost, current cost, realizable value, and the present value. For historical cost, just give few explanation. That means what is historical cost? It is nothing but acquisition cost or your purchase price. According to this, assets are recorded at an amount of cash or equivalents paid because we purchase the assets. What is gone outflow, that will be recorded, and liabilities are recorded at the time of proceeds received in exchange for the obligation. So here they're specifying what does historical cost basically means. Next is current cost. Assets are carried out at the amount of cash and cash equivalents that would have to be paid. Observe the wordings, that would have to be paid, whereas here that is paid, directly given if the same or an equivalent asset was acquired currently. So usage of this word is important while we were explaining about current cost. Then liabilities are carried at the undiscounted amount that would be required to settle the obligation currently. If you are observing the wordings carefully, both is talking about, while with respect to assets, purchase of assets, and with respect to liabilities, settlement of liabilities, but in historical cost it directly connects with paid or received, whereas under current cost it just emphasizes on if it is paid at this point of time or if it is settled at this point of time, what should have been the current specific cost. Clear with this? Then realizable value. As per realizable value, assets are carried at the amount that could currently be obtained by selling the assets in the normal course of business, that is ordinarily disposable, and liabilities are carried at their settlement values. As on today, if I have to sell the asset, what is the value I am supposed to fetch out of the sale amount? That is called as realizable value. Same with respect to liabilities. If I have to settle the liabilities as on the current date, what is the settlement value? Then Present value is nothing but the current today's value by discounting the future prices. The asset is carried at the present discounted value of the future net cash inflows that the item is expected to generate in the normal course of business. In simple words, what does that mean is, if I have to find out the present value of an asset, I will just estimate what is the cash flows I'm expecting out of the respective asset in the future period. So all those values will be taken in the present scenario, applying the respective discounting factor, that is called as present value. Same with respect to liabilities, it is carried based on the future net cash outflows. The difference here is, for asset it is net cash inflows, whereas for liabilities net cash outflows. Based on that, we will just figure out the respective values. If you in short learn this, it is just recording of assets and liabilities depending upon the cost consideration. So historical cost, current cost, realizable value and present value. These were the four generally accepted measurement basis or valuation principles. Most of the students have not given the exact answer for the institute because they have directly misinterpreted the questions and they have not pointed out these four aspects clearly. This is what the examiners comment is. It is a simple topic. Make sure you relevantly know what are the points under the respective headings. This is where majority of the questions will lose marks in theoretical aspect. Clear with this? I hope this was comfortable. Yes. Next part of the first question, record the following transactions in the purchases book. This is a subsidiary book based question. So let's analyze this one by one. Before we run through this, there should be a format drawn. So the format here will be date, particulars, details, and then amount. So first element, first transaction as on 2nd December coming from Gupta and Co. So 100 plates at 150 per plate. We will write this in the description, and then 500 small bowls at 50 per bowl. Total this all, and on this total amount there is a trade discount of 10%. So if I have to calculate 100 plates into 150 rupees, 15,000, 500 bowls into 50 rupees, 25,000. So this totally will be 40,000 on that 10% discount. See, observe here. This totally will be 40,000 on that 10% discount, mean 4,000. The net amount from Gupta would be for 36,000. And there is one more element with respect to this. Packing charges are 2 rupees per plate and 1 rupees per bowl. So there were 100 plates. So 100 into 2, 100 into 2, and 500 bowls, 500 into 1. So this will be 500 and this will be 200. Packing charges would come to 700 rupees. So the total transaction amount from Gupta and Co will be 36,700. I hope this is clear. Next, 6th December, purchased a furniture for shop from plywood company on credit. First of all, will this transaction come in the purchases book? No, this transaction will not be entered in the purchases book because this is a purchase of an asset. We will record only those transactions which are in the form of inventory for the relevant business. So this is in the form of an asset, hence this will not be recorded in the purchases book. If not in purchases book, where will this be recorded? This will be recorded in a separate subsidiary book called as journal proper. I hope this is clear. Next, on 8th December, purchased on credit from Anjana and Co. 50 boxes of spoons at 200 per box. So we will write this in the description. 50 boxes into 200. Then there is 40 boxes into 250. So this total will be 20,000. Upon this, there is 8% of discount. See, this total will be 20,000. On this, there is 8% of trade discount. So the net amount here will be 18,400. Next, 15th December, purchase for cash from Steel House. Again, observe here, this is purchase for cash. Subsidiary book will record those transactions which are done on credit basis. So this transaction again will not be entered in the purchases book. So we will give a note, one for the furniture and this for the transaction happened through cash. Then purchased 1 dozen cookers at 750 each from Verma and Sons on credit. So 1 dozen will be 12 units into 750 rupees. So that is from Verma and Sons. So that will be entered. Miss Verma and Sons, 1 dozen cookers at 750. This is 9,000. How are we getting this? 12 into 750. So this will give us 9,000. Total of purchases book is 64,100. We didn't record two transactions. For that, we will give the respective note. Purchases in cash is recorded through cash book, and purchase of furniture being fixed asset will be recorded through journal, or this can also be called as journal proper. I hope the first question was comfortable and simpler for us to secure complete 20 marks. Yes or no? Yes. Moving on to the question number 2. The following are the details of machineries held by a firm. So they are giving three machineries and the respective purchases dates. Purchase value is also specified, useful life is given, and then there is scrap value also provided. The firm uses, very important observation to be done, sum of years digits method for charging depreciation and maintains a separate account for it. A separate account is maintained for what? For recording depreciation. On 1st April 2024, the M1 machine has become obsolete and has been sold for 1,34,000. On the same date, the estimated useful life remaining of machine 2 is reassessed at 3 years. See, this is happening on which date? 1st April 2024. Machine 2 was purchased on 1st April 2022. So then in this current year, there is a reassessment with respect to useful life with 10,000 as scrap value. There is also a revision in the scrap value as well. Okay. You are required to prepare the machinery account, provision for depreciation account, and machinery disposal account for the year ending 31st March 2024 and 2025. They are asking us to record these transactions in three ledgers for 2 years. First of all, by observing this itself maintains a separate account for it, we will have to be clear that they are not recording the depreciation in the asset account. That means where it will be recorded either accumulated depreciation account or provision for depreciation. The question is mentioning us to prepare provision for depreciation. So we will record all the depreciation entries there. First of all, observe carefully. The transaction is having impact with machine number 1 and machine number 2. Machine number 3 is being purchased in the current year itself because we are recording it on 31st March 2024, 31st March 2025. So there is an asset purchased in the respective year. So there is the details of transactions to be arrived as on 31st March 2024 for machine number 1 and machine number 2. So let's understand this with a working note. I hope all of you are aware of sum of years digits method. So here in this method, we will just take the depreciable value along with the number of years for which we are charging depreciation divided by total sum of years. So on the numerator, we will also have to take the current year as the relevant year for calculating depreciation. What am I trying to tell? You will understand while we observe the working. So here there is machinery account, and then there is provision for depreciation, then there is machinery disposal. See, they are asking us to present it as on 31st March 24 and 31st March 25. If you observe, machine number 1 was bought in 1st April 2022. So first we will have to find out the value of machinery as on 1st April 2023 because we have to close it on 31st March 24 and 25. I hope we are understanding in what way this has to be done. So for this, let's observe the working note. See, calculation of total sum of digits of machine 1 and 2. Okay, so machine number 1 was bought. Sorry for that. That was machine number 2. Machine number 1 was bought in 2020. So from 2020, we will have to find out what is the depreciable value. 11 lakh is the purchase value and scrap value for this would be 20 years. Useful life is 8 years. So keep this in mind. Now let's observe the working. Observe this column, all of you. Machine number 1 cost is 11 lakh. So I want the depreciation for the current year. So how many years have passed? 2020 was the year in which the asset was purchased. So 2020 to 2021, 21, 22, 22, 23. So this 3 years will help me find out the current year depreciable value. So 11 lakh 20,000 was the scrap value. So 11 lakh minus 20,000. If I remove the residual value, which was 20,000, which has to be taken out, depreciable amount will now be 10 lakh 80,000 multiplied by, as I told, we will also have to take in the numerator the year for which the depreciation should also be charged. So 3 years, there were totally 8 years of useful life. So 8, 7 and 6 will have to be taken on the numerator divided by total of some years. So here we can simply apply n into n plus 1 by 2. Useful life for this machinery was 8. 8 into 9 divided by 2. So this will be 36. That is how we are getting 36. I hope this calculation is understood. Yes. Denominator we got 36. So let's solve this. 10 lakh 80,000 into 21 divided by 36. So that will be 6 lakh and 30,000. So 11 lakh is my cost. Total depreciation for 3 years is 6 lakh 30. So 11 lakh minus 6 lakh 30, the residual value, sorry, the WDV, the written down value for machine number 1 will be 4,70,000. Next, likewise for machine number 2, machine number 2 was bought in the year. So let's reflect on the question. Machine 2 was bought in the year 1st April 2022. So we want to just calculate the depreciation for 1 year because we want it as on the year ending 31st March 23. The useful life for this is again 8 years. Scrap value is given as 40,000. So 9 lakh 40 minus 40,000. 9 lakh 40,000 minus 40 will be 9 lakh. We just want it for 1 year. So 8 divided by, hence the total is again 36. So that will be 2 lakhs. So here the WDV will be 7 lakh 40,000. So these are the values as on 31st March 2023 or 1st April 2023. Is this point clear? So this we can reflect it here in the machinery account. See, first of all, understand one thing. Depreciation is not shown in the machinery account. They are maintaining or accumulating it in a separate account called provision for depreciation. So we will record the entries accordingly. So in the machinery, it will be recorded at the original cost itself. Machine number 1 was bought for 11 lakh. So observe here as on 1st April 2023 also, it will be brought down at the original cost itself. So machine number 1 value is 11 lakh at cost and machine number 2 is 9 lakh 40. As on the year end, it will again get closed at the same balances because there is an auction which is happening in the year 1st April 2024. So next 1st April 2024, you will bring down the balance, that is 20 lakh 40, and 1st April 2024, as we saw, this was getting auctioned. So when the machine number 1 was getting auctioned, the sale will not be reflected in the machinery account. They are also asking us to prepare a separate account called as machinery disposal. So every sale entries will be impacted in that particular account. So this amount will be transferred to a separate account called machinery disposal account. So the entry will be machinery disposal account debit to machinery at the original cost itself. Machine number 1 at 11 lakh. I hope till here all of you have understood. Moving on to provision for depreciation. Whatever we have calculated as the provision amount, we will reflect it here. See, first observe, provision for depreciation will have credit balance. So what will be the journal entry? Depreciation account debit to provision for depreciation. So since it has been carried forward in the beginning, so you will have the opening balances which you have already calculated. For machine number 1, it was 6 lakh 30. For machine number 2, it was 2 lakh. How are we getting this? Just before we came across, we have understood how this has been coming. So that is what is written here. Then in the current year, that is as on 31st March 2024, this we will also calculate the depreciation on the respective machinery. This is on the current year. So 1st April 2024, there were some impacts given. Machine 1 has become obsolete and has been sold for 1,34,000. See, before it is getting sold, that particular depreciation needs to be considered. Observe, for machine number 1, 10 lakh 80,000 was anyway after depreciable amount after considering the scrap value. We have already taken the depreciation for 3 years. That was 8th year, 7th year and 6th year. Now the asset is getting sold. We have to first record the depreciation. We are standing at which year? 5th year. So the total here will be by 36. So 5 by 36. The current year depreciation will be 1,50,000. So that is what will be recorded. Likewise for machine number 2, 9 lakh, how are we getting? I hope all of you are clear. So we had calculated depreciation for the 8th year because only 1 year had gone. Then this current year is now 7 by 36. So we will get 1,75,000 as the depreciation. In the current year, there is new machinery which is also bought, which is priced at 8 lakh 10. So this should also be recorded. Machine number 3, 8 lakh 10,000. So this is bought and the residual value is given for 5 years. So again, n into n plus 1 by 2. So 5 into 5 plus 1 by 2. So this will be 5 into 6 by 2, which is again 15. Clear with this? So 8 lakh 10 into 5 by 15. So that will be 2 lakh and 70,000. So here we have calculated the depreciation of machine number 2 for 23-24. For 24-25, I explained you about the machine number 3. For machine number 2, the machine is still present in the business. It is not getting auctioned. So there is a reassessment with respect to the residual value, and considering the impact, we have also have to take the revision in the useful life as well. So revised depreciation will be 5,55,000 into 3 by 6. Now, how did we get this 5,55,000? All of you consider the cost of machine number 2, which was 9,40,000, minus we have calculated the depreciation first till the first year was 2 lakh, and in the year 23-24 it was 1,75,000. The written down value is 5,65,000. 5,65,000. For this, there was a scrap value given of 10,000. So if we minus the revised value, what we are getting is 5,55,000, and they are revising the useful life to 3 years. So 3 into 3 plus 1 by 2, which means 3 into 3 plus 1 by 2. So this is 3 into 4 by 2. 4 3s are 12. 12 divided by 2 will again be 6. So that is how we are getting 3 by 6. And hence the depreciation for this particular year will be 2,77,500. I hope all of you understood what the working was. Now let's observe how this is getting reflected in the ledger. See, as on 31st March 24, for machine number 1, we found the depreciation to be 1,50,000, and for machine number 2, 1,75,000. I hope you are all understanding how are we getting this. See, 1,50,000 for machine number 1 and 1,75,000 for machine number 2. That is what is being entered here. Clear? And then after considering this, 8,30,000 plus 325 will be 11,55,000, which will be taken as balance carried down. For machine number 1, 6,30,000 plus 1,50,000. That is your total depreciation getting added, and for same machine number 2 as well. Clear with this? So this is for the year ended 31st March 2024. This machine number 1 is getting auctioned in the current year. So first of all, whenever there is an auction, remember in the machinery account, when the year of auction came, we literally transferred that particular assets balance to separate account called machinery disposal. So with respect to depreciation, whatever is belonging to that machine is still sitting in provision for depreciation. This also should be transferred to that particular account, which is machinery disposal. Now, which machine was getting auctioned? Machine number 1. What is the balance of machine number 1? 7,80,000. So this is not getting carried forward. So we will reverse the balance. What will be the entry? Provision for depreciation, which will have a credit balance. Now I have to take out, so I will debit. 2. Machinery disposal. So machinery disposal depreciation accumulated was 7,80,000. So we have been recorded that. I hope this is clear. So in this particular year, machine number 1 was still there as on 1st April 24. This is the balance brought down. So that is what is being written. In the ending year, if you observe, by depreciation account, machine number 2 was 2,77,500 and machine number 3, 2,70,000. How we got? We have already understood this calculation. 2,77,500 and 2,70,000. Clear with this? I hope till here all of you done. So then to machinery disposal. Then after considering this, we will only have the balancing figure in machine number 2 and machine number 3. How are we getting this? See here, machine number 2, 3,75,000 plus 2,77,000. 3,75,000 plus 2,77,500. This is 6,52,500. And likewise for machine number 3, only 2,70,000. This has been appeared here. Clear with this? So they are asking us for 2 years. We have been recording it for 2 years. Coming back to machinery account, we had discussed this till here. So in the current year, that is 1st April 2024, machine number 3 is purchased. What is the entry? Machinery account debit to bank account. So that is being reflected here to bank 8,10,000. So then we will find out the closing figure. There will not be machine number 1. So this is an error printing. So this is machine number 2 and this is machine number 3. Make a correction here. Machine number 2 will be standing at 9,40,000. Remember, this is original cost. So same 9,40,000 is carried forward. And machine number 3, 8,10,000. Clear with this? There is one more account which they have asked us, machinery disposal. Machinery disposal, first you have transferred as on 1st April in the machinery disposal to machinery account. This is only to machinery. There is no disposal again here separately. To machinery account 11 lakh. Clear with this? Then from depreciation, provision for depreciation, here we are transferred. So this is by provision for depreciation 7 lakh 80. Now there is an auction money which is worth, we are getting how much? 1 lakh 34,000. What is the entry? Bank account debit to machinery is now sitting in machinery disposal. So to machinery disposal. So whatever we are getting as 1 lakh 34. Understand, find the calculated book value. 11 lakh was the cost minus total depreciation before it was getting auctioned was 7 lakh 80. The value of machinery standing on this date is 3 lakh 20,000. But we are only getting 1 lakh 34,000. So that means the remaining is your loss. How much is our loss? 1 lakh 86,000. So how are we getting this? 3 lakh 20,000 minus 1 lakh 34,000. I hope this is clear to all of us. Understood? So, as per the examiner's comment, this was one such question where most of the students was not able to do a proper calculation. Simple reason being, sum of years digit method, most of the students will just ignore or just observe looking at the formula and they would not practice any such question. In your institute material also, there is no full-fledged question for this. They have given the calculation purpose of how to do the depreciation calculation under sum of years digits method. Here in this question, they have combined this with other concepts as in to prepare machinery account at cost, provision for depreciation and machinery disposal. That is where the conceptual clarity was required and most of the students failed to present the requirement of the question. After discussing this, I hope each one of you watching this video understood this question properly. Yes or no? Right. So this completes our part A of question number 2. Then, moving on to the next question. Pass the journal entries to record or rectify the following transactions in the books of Mr. Dutt. Suspense account may be used if required. Observe one important thing here. They are clearly specifying either record or rectify. So as and when you understand the transactions one by one, you will have to figure out whether it was not recorded means you have to record. If there was any error, we will rectify. With this mechanism, we will have to solve this question. And observe, such questions is again asked for 12 marks. So let's discuss this one by one. Sale of goods to Mahesh at the list price of 1,80,000 less 10% trade discount. Out of the amount due, 50% is received, out of which 2/3 is received by check and the balance is received in cash. CGST and SGST applicable is 6% each. Remember, there is a sale of goods which is happening. So then there is integration of GST to be done. So what is the entry? Normal entry before we understand the due amount which is being received. So we can pass two different entries for this, no worries, because it becomes simpler for you to interpret as well. So Mahesh account debit to sales, to output CGST and to output SGST since there is GST involved on sale. Remember, 1,80,000 is the list price. On there is trade discount of 10%. So 1,80,000 minus 10%, the transaction value is 1,62,000. On this, we will calculate the GST at 6% each. So if I have to take 6% of GST, 9,720, 9,720 will be the respective GST. Now, 9,720 plus 9,720, this was on 1,80,000 minus 10%. 9720, 9720. The total due amount was 1,81,440. Let me show this entry to you so that you will understand properly. So this is what the entry which we discussed. Mahesh account debit to sales to output CGST, output SGST. The same transaction is telling that 50% is received. In that 50%, two-thirds is received by check and the balance in cash. So what is the entry for this? Mahesh is still due by 50%. That means he is your creditor. Yes or no? Sorry, he is your debtor to receive. So we will just record the receipt entry for the partial amount. So the total amount due here is 1,81,450. First take out 50% of this. This will be 90,720. In this 90,720, two-third is received by check. So what is the entry? Bank account debit, cash account debit to Mahesh account with respect to the 50% amount being received. So this is 90,720 into two-third. And this is the remaining 90,720 minus 60,480. I hope this transaction was simple and clear. So next entry. One of the debtors, Mr. X, has agreed to pay his dues of 3,000 to Mr. C, who is a creditor of Mr. Dutt, with the same amount being due to him. So this, they are just routing over the transaction. One of the debtor, Mr. X, has agreed. When he's paying, his balance will come down. So X will be credited. C was your creditor. That if you are that who's preparing these entries, so C was your creditor. So creditor would have a credit balance. When we are settling the amount, his balance would also come down. So the entry will here be Mr. C's account debit to Mr. X account with the amount 3,000, 3,000. See, Mr. C to Mr. X. Relevant narration should also be observed. 3,000 and 3,000. Next. Employees have been given inventory having selling price of 1 lakh, cost price was 75,000 on the eve of Deepavali as a gift. CGST and SGST applicable is 6% each. First of all, understand this transaction carefully. You as a company is giving away the inventories, your own inventories to your employees on the eve of Diwali. So this is as good as you have made the purchases which you are making for the purpose of consumption, not other than manufacturing or towards your business related transactions. So in this case, whatever GST paid on the same would also be reversed. So input CGST, input SGST will be appearing on the credit side. So since this was an inventory, you will have a Deepavali Eve account credited or some inventories account. So let's observe what ICAI has written here. See, miscellaneous expense account debit or Diwali gift account debit to purchases to input CGST and to input SGST. This was your own inventory. They have given us the selling price as well as the cost price. So we will record it at the cost price, which was 75,000. And then on that 75,000, I guess it was 6% GST. So 7,500 into 6%. 7,500 into 6% will be taken, and these were the respective GSTs. So the entry will be miscellaneous expense or Diwali gift to purchases. The GST paid on this will be reversed. So input CGST and then input SGST. I hope this is clear. Next entry. Sale of 2,500 made to Mr. Kamal Kumar has been debited to Mrs. Kamala Rani. Again, this is a error wherein we have to pass the rectifying entry. Sale of 2,500 to Kamal Kumar. The entry should have been Kamal Kumar account debit to sales. But now what has happened? So this is being debited to Kamala Rani. So this Kamala Rani's account needs to be cancelled. So what will be the entry? Kamal Kumar account debit to Kamala Rani, where we are passing the rectifying entry. See, Kamal Kumar to Kamala Rani, 2,500, 2,500. Next, a second-hand machinery was purchased and its overhauling charges paid are 15,000. The accountant debited the overall charges to repairs and maintenance account. Depreciation on machinery has been charged at 10%. First of all, the purchase of an asset. So any expenses related at the time of purchase will have to be added to the cost of the asset. But what has the accountant done? They have treated it as a revenue expenditure instead of capital expenditure. So we have to first reverse it. Overall charges has been debited to repair and maintenance account. That needs to be eliminated. So we will credit repairs and maintenance. On the same, there is depreciation also to be recorded. So that depreciation will be charged at 10% on 15,000. So what will be the journal entry for this? It will be machinery account debit because it was debited to repair and maintenance. See, this is again credited. Machinery account debit 13,500 because there is depreciation at 10% on this as well. So depreciation was anyway supposed to be debited at 10%. So that is 1500. Repairs and maintenance, which was a wrong debit, now credited by reversing it at 15,000. See, which is wrongly debited to repairs and maintenance is now rectified. Is this understood? Yes. Next, a purchase of 151 from Mr. X was entered in purchase day book as rupees 15 and posted to X account as 51. Purchased amount was 151. Mr. X was entered in purchase day book as 15. So again there is a mismatch with respect to amount and posted to Mr. X account as 51. So entry was wrong and posting was done at 51. Understood what is the transaction all about? Purchase of 151 was entered in purchase day book as 15. So first of all, in the purchase day book, the amount needs to be corrected. So 151 was the transaction amount, but we have recorded it as 15. So the difference is 136. So how will I increase the purchase book balance? By debiting purchase account. Purchase account debit 136. I hope this is clear. Coming to Mr. X. X account will be anyway credited. This was posted as 51. Actual posting was supposed to be 151, but they've taken 51 out of it. That means 100 is a shortfall. Yes or no? So this 100 will also be taken care. And the balance with respect to what is reflecting will be routed through suspense account. Now how this entry will be presented, observe here all of you. Purchases account debit 136. As I told, they have taken only 15. So difference between 151 and 15 to X 100 because X was anyway credited with 51. The balance to suspense account by 36. Clear with this? How this is being done? So being purchases of 151 from X wrongly posted as 15 and posted to X as 51 is now being rectified. Clear with this all of you? Yes. Next. R has been issued a credit note allowing rebate of 6,000 as goods supplied to him was found defective. CGST and SGST charged was 6% each. When you are issuing a credit note, that means you would have made a sale and there would be some defect about your product. That is when a business will generate a credit note to another party. So on this credit note, you are allowing a rebate. Rebate is nothing but which is equivalent to discount, which is your loss or an expense. So this account will get debited. Now there was CGST and SGST charged. At the time of sale, you would have credited this. This would be rectified. This would be reversed now. So we will debit the respective CGST and SGST account. So what will be the journal entry? And this will be routed through R's account. Observe here. Rebate account debit, output CGST, output SGST to R's account because this is being returned to R. That is the rebate which was being allowed to R. So rebate was 6,000. On that GST was 6%. So 360, 360 each. 6,000 into 6%. Clear with this all of you? Yes. Next. S was also given a credit note of 2,000 for making prompt payment for outstanding against goods sold to him. CGST and SGST charged on sale was 6%. So S was also given a credit note for making prompt payment. Means we have to record this transaction. So how will we record this transaction? Observe here all of you. Discount is allowed to S, that is discount allowed account debit to S because we are allowing for prompt making prompt payment means it is our loss. So debit all expenses or losses, discount allowed debit. Whom are we giving this to? S. So the amount is 2,000 and 2,000. Being credit given for making prompt payment for outstanding goods sold. So this is your narration. Next transaction, an accrual of telephone charges for 2538 has been completely omitted. That means there is an omission of error of omission which needs to be recorded. An accrual of telephone charges has been completely omitted. First of all, accrual means it is outstanding. So what will be your journal entry? Telephone charges is an expense. So telephone charges account debit. It is outstanding in the nature of liability. To outstanding telephone charges 2538. So this will be your journal entry. See, telephone expenses to outstanding expenses 2538. Clear with this? Next. A check of 25,390 issued to Mr. C. Das, shown under trade payables towards his dues, has been wrongly debited to the purchases. A check of 25,390 is issued to Mr. Das. So when you are issuing the check, Mr. Das would have been receiving it. Actually, his account should have been debited towards his dues has been wrongly debited to purchases. So the wrong debit is done to purchase. So what will be the rectifying entry? Das account debit to purchases 25,390. This will be your rectified entry. See, Das, Mr. C. Das account debit to purchases. Being checked, issued, wrongly debited is now rectified. So this was all of your journal entries where you were either supposed to record or rectify. This was an interesting set of transactions which becomes very important for your practice. I hope you have understood each transactions which were discussed in detail. This completes your question number 2. Let's move to the next question. Question number 3. From the following particulars furnished by Mr. Y, prepare his trading and profit and loss account for the year ended on 31st March. Also prepare his balance sheet as on 31st March 2025. So they are giving us the list of details, and there is also a note, no fixed asset has been sold during the year. See, first of all, in this question, as in when you read, prepare his trading account P&L, most of the students will confuse this as a final accounts question also. But remember, there is also a chapter called single entry or account from incomplete records, which will have again requirement for you to prepare either profit and loss, trading and balance sheet. But the difference between final accounts in this particular chapter is there would be some incomplete information wherein you will have to figure out, find the data and then take it to the respective financial statements. So this is a question coming from your account from incomplete records chapter. First and foremost, most of the students fail to observe this. And if you do not understand this is coming from this chapter, you will not certainly get an idea what all accounts need to be presented. First and foremost, there will be some information which will be missing and you will have to figure it out. To figure out, we will have to make respective working notes. We have understood in detail in that particular chapter. So let's understand the respective solution in one single hand. So there is opening balance is given and then there is closing balances provided. Always and always when you have such question, prepare creditors account and debtors account. These two are must. Sometimes there would also be cash book required. If there is any details provided with respect to that cash transactions, make sure you also make that as a working note. In this, we have observed creditors account where we are also observing debtors account. There is also another expenses outstanding, fixed assets, stock in hand, cash in hand, cash at bank. You need not prepare a separate account for this because this will anyway get placed in the respective financial statements. So there are other 4 items. It is always better to prepare ledger as a working note of these items. So we will open creditors account, take the opening balance, closing balance, likewise expenses outstanding, fixed assets account and then debtors account as well. So creditors opening balance will appear on the credit side 6,38,000 and the closing on the debit side 4,96,000. Let's observe this. See here creditors, to balance brought down and then to balance carried out. We're just entering the details what is given. Then we had expenses outstanding. Opening balance 24,000, 13,200, closing balance. Expenses outstanding means it will be your liability. So opening will have on the credit side, closing on the debit side. 24,000, 13,200. Expenses payable 24,000, 13,200. Clear with this? Yes. Then there was fixed assets which also includes the machinery 4,64,400, 481,600 opens on the debit side, closes on the credit side 464,400 fixed assets account 464,400 and 481,600. Clear with this? We are just entering the values and hence I have highlighted those. Then there is stock in hand. Opening balance will go to trading account, likewise closing stock, and then in the closing balance sheet. So 3,21,600, 4,44,800. Now in the entire question, we should also have to analyze one thing, whether they have given any capital balances, opening capital balances for the purpose of our closing balance sheet. Let's quickly analyze that. If not given, it is also better to incorporate that in your working note, so the time consumes lesser. Okay, there is no opening capital balances in this question, so we'll also prepare one opening balance sheet. So fixed assets opening balance will go in that opening balance sheet. Opening outstanding under the liabilities, and then creditors under the liabilities again. Stock in hand 3,21,600, 4,44,800 in the trading account. 3,21,600, 4,44,800, and we have been presenting closing balance sheet. See here, 4,44,800 in the closing balance sheet. If there is opening balance sheet, we can also observe the opening balance, fixed assets, then there was sundry debtors, creditors, expenses outstanding. All these was already discussed. Then there is cash in hand, 1,18,400 and 48,000. This will directly sit in the balance sheet. So closing balance sheet 1,18,000. Closing balance sheet was 48,000. Opening 1,18,400. See, closing 48. Opening 1,18,400. Then we have cash at bank, opening 1,60,000 and closing 2,75,200. 2,75,200. This is the closing balance sheet 31st March 25, and opening balance sheet 1,60,000. I hope this is clear. So after we have entered all that, anyway we have completed the opening balance sheet values. The difference amount whatever we get will be the opening capital balance, which is 10,70,800. Where will this come? We will take this balance to the closing balance sheet, 10,70,800. Whatever we have understood, I've just highlighted to just re-not visit again. Fixed assets closing was anyway there, 4,81,600. That is also entered in our closing balance sheet. So sundry debtors closing was not given. Creditors 4,96,000 was given. This was all available already. So just highlighting the same since we have considered. Now observing these details one by one. Cash and discount credited to debtors. So there is both involved, cash as well as discount. So the journal entry would be cash or bank account debit, discount allowed account debit to debtors. So here we have cash or bank, discount allowed, debit to debtors. So they have given one final amount, 25,60,000. We need a breakup. So we will just observe carefully. Is there any additional information given? Returns from debtors 58,000. So this is your sales return. What will be the journal entry? Sales returns account debit to debtors. So we have opened the debtors account. This will be placed there. By sales returns 58,000. See here in debtors account. Return inwards 58,000. So this was your sales return. We will also enter it in our trading account, less sales return 58,000. Then bad debt 16,800. The journal entry for this again will be bad debts account debit to debtors. This is also your loss, will appear also in your profit and loss. 16,800. Observe here in the profit and loss account to bad debt 16,800, and in debtors account by bad debt 16,800. Clear? Next, gross sales, both cash and credit. So total sales is given 28,72,400. So in order to consider the debtors, I want credit sales. Here both sales are given. So we will directly take this in our trading account, 28,72,400. There is no breakup yet available. Discount allowed by creditors. So what will be the journal entry? Discount allowed by creditors. Creditors account debit to discount received. So we have opened the creditors account. So this will be reflected in that account. Discount received is your gain and in P&L account. 28,000. See here in the profit and loss account, discount received 28. Creditors account, discount received 28. Clear with this? Yes. Next, we have returns to creditors. That means you're making a purchase return. What will be the entry? Creditors account debit to purchase returns. 16,000. First, this will be reflected in your trading account. Here they have taken 16. Let me explain how the other values are given in a while. Yes, there was a purchase return. So what will be the journal entry? Creditors account debit to purchase returns or returns to creditors. So that was 16,000 that has been entered here. Later, then we have capital introduced by check. Capital introduced by check is nothing but your additional capital introduced, 3,40,000. This will appear in the balance sheet, 3,40,000. See here, capital introduced, 3,40,000. Clear with this? Next, we have collection from debtors deposited into bank after receiving cash. Remember, there was one transaction, combined amount was given 25,60,000. Now we have got the breakup. That is how much is collected from debtors. So 25 lakh is collected from debtors. How much will be the discount allowed amount? 60,000. So this will be entered in the debtors account. So by cash, by discount allowed. See, in the debtors account, by cash 25 lakh, discount allowed 60,000. I hope this is clear. Next, cash purchase. Now there is a breakup given. Cash purchases is given. If you observe till now, they have not given us the purchase value 41,200. So we will anyway take it in the trading account. 41,200 taken. Next, expenses paid by check. Sorry, expenses paid by cash. So this will appear in my profit and loss, 3,82,800. So in the profit and loss account, two expenses. Okay, we had opened expenses outstanding account. Remember, that is your liability. So expenses paid will also have an entry here. When you are paying, there was outstanding balance. That is your creditor. So what will be the entry? Expenses payable account debit to bank. How much we have paid? 3,82,800. So after considering this, we will have a closing balance of, which is given to us in the question, 13,200. So after writing off all of these values, remember to close the ledger, always have four items into consideration. Opening balance, closing balance. Then there will be some item which will be transferred to the current year profit and loss for the expenses, and then some amount which will be settled. So here there was some amount which is being paid to bank. So the difference which is going to the profit and loss account will be nothing but your balancing figure, 3,72,000. This will be shown as your current year expenses. That is how we are getting 3,72,000 as per the expenses outstanding ledger calculation. That is why we observed that preparing ledger becomes important, because this all values will be generated there itself. Next. So then we have drawings by check, 17,200. This will again be appearing in the balance sheet. See, less drawings, 17,200. Then we have machinery acquired by check, 1,27,200. There was one fixed assets ledger opened. When the machinery is acquired, what will be the journal entry? Fixed assets account debit to bank. So 127,200. I will enter this fixed assets to bank, 127,200. There was opening balance given, there was closing balance available for fixed assets as well, and they have clearly mentioned in the question, no fixed asset was sold in the current year. So there is a difference which will be nothing but depreciation on machinery, because this is an asset. So every year depreciation should anyway be charged. So the balancing figure will be depreciation 1,10,000, which will appear in the profit and loss account. Depreciation on fixed assets. Are you observing why preparing ledger accounts as working note becomes important? Because these are nothing but incomplete, unavailable information to us, wherein we are figuring it out by making the respective transactions entered. Clear with this? Next. Then we have cash deposited into bank 2 lakh. So we have neither preparing cash book or bank account. So this entry will have no relevance to enter. Cash withdrawn by bank likewise. Cash sales. Cash sales is given. Remember they had given us the total sales 28 lakh 72,400. We have opened a debtors account. Credit sales was supposed to be taken there. Debtors account debit to sales. They have given us cash sales, so we can find out how much is the credit sales. 28,72,400 minus 1,84,000. This is my credit sales. 26,88,400, which will be entered in the debtors column. See this two sales 26,88,400. Remember in the question debtors closing balance was not given to us. Now we have entered all the values, so we can find out the closing balance of debtors as a balancing figure 7,14,800, which will also appear in the closing balance sheet. Clear with this? Then we had payment to creditors by check. So what will be the entry? Creditors account debit to bank 24,10,800. So this will appear in the creditors account 24,10,800. Now here again opening balances was given, closing balances given, all other details are entered in the creditors account. If you remember in the question they had not given the credit purchases value. So whatever we are going to get as a balancing figure is nothing but the credit purchases 23,20,000. So this will be taken to my trading account plus 23,20,000. All pointers clear? Yes or no? So this was all the question. Now we will just have to close the account. See, opening stock was entered, purchases, net we have taken, cash purchase, credit purchase minus returns. Then sales, we have taken total sales minus any returns. Then closing stock was given. So we will find out the gross profit. Take the balance to the profit and loss account. We have entered all the expenses and income. This discount allowed to debtors, we found out how it has been arrived. So we get net profit as 61,600. This will be taken to our capital. Opening capital was found out by preparing the opening balance sheet. To this we will add net profit, capital introduced in the current year, and then subtract drawings. We get 14,55,200. Remaining all other values have been considered. The total of balance sheet what we get will be 19,64,400. So make sure you all guys solve this once, since you have now understood how the values are reflected here, and make sure that you're not going to miss on the working note. This question will definitely take your time, but with a good practice you can easily complete it, because once you close the question the balance sheet automatically tallies and you will be in a safer position to score full 12 marks. Clear with this? Yes. So this completes this question. Next question. Mr. P was carrying on a business. On 1st April 2023, he admitted Q as a partner, giving him 1/4 profit. See, there was only one person P. He was carrying on the business and then he admitted Q. It was agreed that the goodwill of the firm would be 24,000. So they are valuing the goodwill. On 1st July 2023, R was admitted as a partner and it was agreed that the goodwill of the firm be determined at 40,000. Now when Q was admitted, goodwill was 24. When R was admitted, the goodwill is 40,000. And the new profit sharing ratio of P, Q and R is now 3:1:1. Next, on 1st September 2023, S was also admitted as a partner, and at this time, goodwill was valued at 72,000. Now there are P, Q, R and S. So they agreed to share the profits in the ratio of 3:1:1:1. On 1st April 2024, R decided to retire and T was admitted as a partner. Goodwill at this time was 96,000 and the profit sharing ratio among P, Q, S and T was 5:4:3:4. All these agreements about goodwill have not been taken into account. On 1st April when R retires, T is admitted. The partners decided to account for the goodwill by making necessary entries in respect of goodwill in the books without keeping the goodwill account in the books. That means they are not ready to show this as a separate asset. You are required to show working of the goodwill and to pass the required journal entry. So What is the requirement here is whenever there was rearrangement happening, that is one-on-one partner getting admitted, the firm has not at all passed the goodwill respective entries. Now they are asking you to prepare those entries. Along with that, they are also asking to find out the net impact because there was one partner getting retired and one getting admitted. So how should we solve this? Just observe carefully, guys. This could be a new set of questions when you have seen this on the exam. But application of concepts is already what you know. Whenever there is admission happening, new partner is supposed to bring his share of goodwill. If not, we can find out using his proportionate giving the firm's goodwill. Yes or no? This is one point. And when there is admission happening, the new partner has to provide his compensation for the old partners in which ratio? Sacrificing ratio. Likewise, at the time of retirement, when the partner is going out of the business, whatever his share will be given back to the remaining partner. What is the ratio that we need to find out at that moment? It is called gain ratio. These points, I hope all of you are clear. That is what we have to just solve and just present one combined journal entry as per the requirement of the question and find the respective net amount. So let's understand with the ICAI solution itself how it is to be done. This is the final entry. First, we will understand how this is taken. See, on 1st April 2023, Q is admitted and Q is given 1/4 share in profit. Yes or no? So, the value of the goodwill, firm's goodwill at that point of time was 24,000. He has to bring his share of goodwill. So, 24,000 into 1/4, 6,000 will be their proportion of goodwill. New profit sharing ratio of P and Q was 3:1. Now, this 6,000 has to be provided to P in the sacrificing ratio. Understand one thing, the sacrificing ratio is 1 since entire sacrifice is made by P only. If the ratio is 3:1, that means Q is getting 1. From whom is Q getting? From P itself, because he was the only one person in the business. So here the entire amount of 6,000 will be provided to P. I hope this is clear. Next, on 1st July 23, R is admitted and the old ratio between P and Q is 3:1. New ratio, the question itself is giving as 3:1:1. Now R is admitted, that means he has to find out his share of goodwill. What was his share of goodwill? If you take it from this ratio, 1 divided by 5. 40,000 was his share, so 8,000 will be his amount of goodwill. We have to calculate sacrificing ratio. How do we calculate sacrificing ratio? Old ratio minus new ratio. If I have to calculate for P, what is the old ratio of P? 3/4, this one. Minus, what is the new ratio of P? 3/5. So 5 fours are 20, 4 fives are 5 threes are 15, minus 5 fours are 20, 4 threes are 12. So this will be 3/20. And then for Q, 1/4 minus 1/5. So this will be 20 again, 5 minus 4. So 1/20. Sacrificing share is 3/20, 1/20. Sacrificing ratio will be 3:1, which is what is given here. Clear with this? So this 8,000 will be apportioned in the ratio of 3:1. How to do that apportionment? We will have a separate working for that. So first let's find out these ratios. Then there is S getting admitted for the proportion of 1/6. So the goodwill at that point of time was 72,000. His share is 1/6, 12,000. Again, we need to find out the sacrificing ratio. We have to do the same thing, old ratio minus new ratio. We will get the sacrificing ratio as 3:1:1. So this 12,000 will be apportioned in 3:1:1. Then on 1st April 24, R is getting retired and T is getting admitted. So here we will also have to find out gain as well as sacrifice. So we will apply one structure. So if there is positive, it will be sacrifice. Negative, we will term it as gain ratio. For P, what is the old ratio? 3:1:1:1 is the old ratio. So 3/6 minus 5 plus 4 will be 9 plus 3, 12. 12 plus 4, 16. So 3/6 minus 5/16. If I have to take LCM between 6 and 16, we get 48. How are we getting that? 6/16. If I take the common value, 2 3s are 6, 2 8s are 16. So then 8 threes are 24, 24 twos are 48. That is how we are getting 48. So 48 is the denominator. 3 by 6 into 48, that will be 24, and 5 by 16 into 48, that will be 15. So 9 by 48. The value is positive, so we term it as sacrifice ratio or share. And then likewise for Q, 6 and 16 we are getting 48. So 1 by 6 into 48 will be 8, and 16 48 will be 3 fours are again 12. 3 into 4, 12. So 8 minus 12, here we are getting a negative value. So the gain ratio will arrive. R is retiring. So whatever is there, we will term it as sacrificing ratio 1 by 6. Then S, 1 by 6 minus 3 by 16. Again, if we subtract, we get minus 1 by 8, which is again a negative. So it is a gain ratio. T, who is the new partner getting admitted, he's just gaining because he is not having any old ratio. 4 by 16. How are we getting 4 by 16? It is given in the new ratio. So 4 by 16 he will gain. Now from the notes, whatever we discussed so far, it is about the ratios arrived and the values which is taken from the share of the goodwill, the respective partner who need to compensate. But here we need to find out the net values in order to pass one single entry. Clear with this? Understand this carefully. It is simpler. Do not get feared by just looking at this table. There is also an alternate treatment. You can follow that if you are comfortable, but I feel that this structure is more easier to understand. Focus and carefully observe this. See, on admission of Q, P was only one person. So through the calculation, we understood Q's share of goodwill was 6,000. Only P was there, so entire amount should be given to P. When P is receiving the amount, his capital account will be credited, yes or no? And who is giving Q? So Q capital account will be debited. Henceforth, 6,000 credit for P and debit for Q. We have just made the respective partners column P, Q, R, S and T. Second case, R was admitted and his share of goodwill was how much? 8,000. So he has to give this to P and Q in the proportion of 3:1. So 8,000 into 3 by 4. 6,000 for P and 2,000 for Q. This is the amount. When these both are receiving, their capital accounts will be credited. Who is giving R? So P and Q. 6,000 credit, 2,000 credit, 8,000 debit. I hope all of you are comfortably clear till here. Then later on admission of S, 12,000 is their share. This has to be given to P, Q, R and S. So 12,000 into 3 by 5. This will be 7,000. Let me write it here so you guys will understand. 12,000 into 3 by 5. This will be 7,200. Q, 12,000 into 1 by 5, 2,400, and R, 12,000 into 1 by 5, again 2,400. These three partners are receiving, so their account will be credited. Who is giving? S. So entire 12,000 will be debited. Observe here. 7,200 credit, 2,400 credit, 2,400 credit and 12,000 debit. Clear? Next. On retirement, and T is admitted. Now, if you observe, what is the proportion of goodwill at the time of retirement and admission? Value of goodwill, I guess it was around 96,000. So, 96,000 is the value of goodwill. Now, this should be brought in by the new partner and we have to also compensate it for the old partner. Yes or no? Now, understand this carefully. On retirement of R, he is sacrificing 1/6. What is his share? 96,000 divided by 6. 16,000 is his share. So he has to receive that 16,000. How are we getting? 96,000 into 1 by 6. Clear with this, all of you? He has to receive this amount. Likewise, P has to bring in his share of goodwill. 96,000 into 4 by 16. How much is that? 24,000. So T has to bring in means T account should be debited by 24,000. Clear with this all of you? 96,000 into 4 by 16. 4 by 16. Yes. Now, this 24,000 has to be provided to the remaining partners. Yes or no? So, how will we do this? 96,000 has to be given to P, Q and S. This 24 has to be provided. But observe one thing. P is sacrificing whereas Q and S is gaining. So, what will be the entry? P will have to receive and Q and S will have to provide. P is sacrificing, he will have to receive. So when he receives, his account will be credited. So the total goodwill was 96 into 9 by 48. 96,000 into 9 by 48. I'm just emphasizing why is there a credit balance here. And likewise for Q, 96,000 into 4 by 48. This is into 4 by 48, then there is less space, so just I'm writing into 4 by 48. I hope this is clear. And then likewise 96,000 into 1 by 48. Understood? So now we have the total of impacts for the respective partners. So we will just calculate C for P, 6,000 credit, 6,000 credit, 7,200 credit and then 18,000 credit. Total 37,200 credit. That means P's capital account will be credited. This is what it indicates. Likewise, for Q, 6,000 debit. Then there is 2,000 credit. That means we will minus 2,400 plus 8,000. So this will be 9,600 debit. Q's capital account will be debited. R, 8,000 debit. 2,400 credit means minus 16,000. So 10,400 credit. It started with debit balance. So 10,400 credit. So R's capital account will be credited. Then S, 12,000 debit, 2,000 debit. So 14,000 again debit side. 24,000 debit. So the entry, combined journal entry will be R's capital account debit. This is S capital account debit, T's capital account debit to P's capital account and to Q's capital account. So this to R's capital account, sorry. This will be the combined journal entry. Now with respect to this question, examiner commented that most of the students failed to pass one combined entry and few students did the ratio calculations correctly, but majority of them failed to present this as a combined entry. Simple reason being, the one confusion point where we would have missed would be when there is retirement and admission. Commonly, what you can simply do is instead of taking the respective ratios, keep it in the same share. See, if you observe in the column, that's what I did here. I took 96,000 directly and applied the respective shares itself. I didn't combine that in the ratios. So that is where you get the combined structure, and this is how you can find out one statement that will become more easier to find out this exact common values net amount. Clear? This question, if you observe for the first time, you will feel it is complicated, but if you just break it down when the retirement admission happens with respect to concepts along, you might definitely get closer to it. If not correctly, but you can definitely attempt this with respect to your working notes calculation. Clear with this? Practice this really well, guys. One of the good question. Yes. This completes our question number 3 as well. Yes. Let's begin the next question. Question number 4. P and Q have been carrying on the business in the name of Bharat Springs in partnership, sharing profits and losses in the ratio of 2:3. Their balance sheet as on 31st March 2024 has been as follows. They have given the balance sheet. On 1st April 24, they have decided to admit R into the partnership, giving him a 1/5 share in future profits on the following terms. So this is an admission question. They have given us old ratio and future share. R will bring 80,000 as a share of capital but is unable to bring in cash for his share of goodwill. It was decided to calculate goodwill of the firm based on R's share in the profits and the capital contribution made by him to the firm. First of all, what does it mean? They have not given partner share of goodwill, neither they have given the firm's goodwill. You are asked to calculate his goodwill. To first of all do that, we have to calculate the goodwill of the firm. They are giving us the terms on how to calculate goodwill of the firm based on R's share in the profits and capital contribution made by him. Here, in simple terms, what they are trying to tell is the goodwill is hidden. You will have to apply the steps to calculate goodwill, hidden goodwill, and then find out the firm's goodwill. So we can do that easily, keeping the new partner's capital as base, which is 80,000. Then, partners will not withdraw their share of goodwill, nor will the goodwill appear in the books of the accounts. Okay. Next, general reserve will be transferred to partners' capital account. Provision for doubtful debts is to be made on debtors at 2%. Liability of creditors of 1,440 is to be written back as no longer payable. Stock shall be written down by 10%. Building revalued at 1 lakh, plant 60, furniture at 24,000. Partners agreed that the values of the assets and liabilities will remain the same, an important consideration here, and as such, there should be not be any change in their book value because of above mentioned adjustments. They also agreed that for the purpose of goodwill computation, any effect on revaluation shall be ignored. So, what does this entire point in simple words means? The question is anyway mentioning us we are required to make memorandum revaluation, capital accounts of the partners and balance sheet of the new firm. So this clearly means that the partners does not want to change the values of assets and liabilities, and that needs to be reflected in memorandum revaluation account. So the question is pretty simple. Other than two important adjustments, one is about goodwill calculation and presenting memorandum revaluation account. So first, let's consider memorandum revaluation account. They have given us the details. Provision for doubtful debts is to be made at 20 debtors at 2%. Debtors is 48,000, 2% on this on the debit side in memorandum revaluation to provision for bad debts. 28,000 into 2%. So what was the amount of debtors? Sorry, it is 48,000 into 2%. So 48,000 into 2%. Then we have liability of creditors 1,440 written bank as no longer payable. Observe one thing, there is a creditor of 57,800. Out of that, 1,440 is to be written back as it is no longer payable. What does this mean? So they are need not be paid. They creditors what you have having as a liability, they need not be paid. That means you are saving, gaining on this. So that will appear on the credit side of memorandum revaluation by liability of creditor 1,440. Clear with this? Then stock shall be written down by 10%. Reduction in the value of stock. So this will appear on the debit side. To stock 5,480. 54,800 was the value of stock. Building is revalued at 1 lakh. The value of building is 85,000. So there is increase in the building. So on the credit side of memorandum revaluation by building 15,000. So that is 1 lakh minus 85,000. Then plant at 60,000. Value of plant is 55. So there is increase in the value of plant by 5,000. So by plant 5,000. Clear? Then we have furniture at 24,000. Furniture was shown in the balance sheet at 26,700. So there is decrease in the value of furniture. So two furniture in the revaluation account 2,700. Clear with this? So we have entered all the values. Observe one thing. First part will be normally as revaluation account. So we will apportion the revaluation profit or loss in the old profit sharing ratio. What is the old profit sharing ratio? 2:3. So we have taken all the values. So there is profit on revaluation 12,300 will be apportioned in the ratio of 2:3. Clear with this? Since they have asked us to prepare memorandum revaluation, whatever entered will automatically be reversed. One important thing here is when we are reversing, we will have a loss since we had got profit on revaluation. This loss will be apportioned to all partners in new profit sharing ratio. This point most of the students have missed is as per the examiner's comment. So make sure we are not losing marks here. So this needs to be apportioned in new profit sharing ratio. So see, provision for bad debts 960, stock 5480, furniture 2700 likewise written, liability of creditors, building and plant written. So again your loss will be 12,300. Only difference is it will be shared to all partners in new profit sharing ratio. In the question, they are not given us the new profit sharing ratio, but they have given us the old ratio and the future share. So can we calculate new profit sharing ratio? Yes or no? So there is a working note. Our share is 1/5. So remaining share, if I have to calculate, if I take the whole share as 1, remaining share will be 1 minus 1 by 5. So this will be 5 minus 1, which is 4 by 5. So old ratio into remaining share. For P, old ratio was 2 by 5. Remaining share is 4 by 5. So this will give us 8 by 25. Q share, old ratio was 3 by 5 into remaining share 4 by 5. This will give us 12 by 25. So the denominator here is 25. Future share of R was 5. So in order to proportion it to 25, 5 by 25. So your new profit sharing ratio will be 8 is to 12 is to 5. This is one working note which is required to close our memorandum revaluation. Will be distributed in 8 is to 12 is to 5 ratio. Clear with this? First we have prepared memorandum revaluation. Second, open partners capital and then balance sheet. Partners capital, first we will bring down the balance by balance brought down. 80, 160, there was only 2 partners. Then there was general reserve, which will be apportioned in the old ratio again. What was the general reserve amount? 50,000. 50,000 will be apportioned in the ratio of 2 is to 3. So 50,000 into 2 by 5, 20 and 30. 2 is to 3. So this is done. Then there is new partners introduction. He is bringing 80,000 as capital. What will be the journal entry? Bank account debit to R's capital account. So that is what is reflected here. So this is understood. This is understood. And then this is done. Clear with this? Now, as soon as we do this, we had anyway prepared memorandum revaluation. We had got profit and loss. We will transfer that to the capital account. Memorandum revaluation, by memorandum revaluation you will transfer the profit, and then to memorandum revaluation wherein you will transfer the loss. This point is clear. Until here all of you should be comfortable. The next entry would be to find out the firm's goodwill. There the question is clearly specifying you can use the new partner's share along with his future profits. What is the capital brought in by the new partner? 80,000. His future share is 1/5. Observe one thing carefully here. We have to take all the adjustments before the admission. So if I have to take here the total capital of the firm, how do I calculate? Take the reciprocal of the new partner share into 1/5 is nothing but into 5 by 1. So total capital will be 4 lakh. Now find out the existing capital as available in the firm. So P, Q and R has respective balances. Observe in the question, P had 80,000, Q had 1,60,000. So 80,000, 1,60,000, Q is additionally bringing 80,000. Remember one thing carefully here. This is where most of the students have lost their marks and have missed this also. General reserve also belongs to the partner itself. General reserve is getting transferred because of admission. That means this balance was already existing before admission, which purely belongs to the partners itself. So that should also be taken into consideration. Plus 50. So the entire thing will be called as the total capital existing, including general reserve. So that is 3,70,000. So this difference is nothing but our goodwill. So this 30,000 will be the firm's goodwill. But what I literally want here, the partner share. The future partner share is 1/5. So 30,000 into 1 by 5 is 6,000. This 6,000 will have to be apportioned to old partners in what ratio? In sacrificing ratio. Sacrificing ratio, how do we calculate? Old ratio minus new ratio. Yes or no? We anyway have old ratio. We also have new ratio also. So let's roughly calculate here for P and Q only. Old ratio is 2 by 5, 3 by 5. New ratio for P, 8 by 25 and 12 by 25. So LCM between 5 and 25 is still 25. 5 fives are 25, 5 twos are 10, minus 8. This is 2 by 25 and 25 here. 5 threes are 15, minus 12 is again 3 by 25. So the sacrificing ratio will again be 2 is to 3. That is what is given. So this 6,000 will be apportioned between the partners in the proportion as 2 is to 3. So what will be the journal entry? Who is the receiving partners? P and Q, and R will have to provide. So the journal entry here will be R's capital account debit to P's capital account to Q's capital account. He has to bring 6,000. 6,000 into 2 by 5, 2,400 and 3,600. Clear with this? Now this will be reflected in your ledger. R's capital, 2P and Q, 2,400 and 3,600 in R's column, and then by R's capital in P and Q's column, 2,400, 3,600. This was the entry. Now we have reflected all of the amount. So we will find out the closing capital balance. So this will be your closing capital balance, which will have to be taken into the balance sheet. Remember one important thing. The question is clearly emphasizing that partners are not required or do not wish the value of the assets and liabilities remain the same. So when we are preparing the balance sheet, and also the question is clearly indicating about memorandum revaluation, you will have the exact same values and not the revised or revalued values. This is where most of the students have committed the mistake. Clearly remember one thing, guys. When the question is asking or clearly specifying the partner's wish is to not change the value of assets and liabilities, you will remain the same values as it is. And if the question is also specifying to prepare memorandum revaluation, it also means the same thing. They want to carry over the same existing values. So your only change will be with respect to capital account. This is what you are getting: 1 lakh 3,384, 195.76 and 71,540. That is the change. Apart from that, you will have the impact in your bank account. How? Observe in the existing balance sheet, your bank account balance was 83,200. In the admission, the partner who's incoming, he will also add his capital balance. So what will be the journal entry? Bank account debit to R's capital. So bank balance will increase by 80,000. That is what is added here. 80,000 increased. I hope this is clear. After you consider, you will get 4,44,300 as your total of balance sheet. As I told you initially itself, the question was simpler. You have to just cope up with the two adjustments. One with respect to hidden goodwill, wherein the students can miss out to take general reserve, and then with respect to the balance sheet, most of the students have committed the mistakes of taking the revalued figures. Remember carefully, when there is memorandum revaluation, we will take the exact details apart from whatever balances get revised due to capital account and introduction of new partners capital. I hope this is clear. Yes. Next question. Following is the receipts and payments account of Smart Club for the year ended on 31st March. They have given us the receipts and payments account. And then what is the requirement? Prepare income and expenditure from the above particulars and balance sheet as on that date. See, this is a not-for-profit organization question. Whenever you observe the question as a working note, there is subscription details anyway given. So we will have to make this as a working note. Along with that, also observe whether there is any capital fund balances given. If not, for that also we have to prepare the opening balance sheet. That will become your working notes. So now let's open income and expenditure account and then closing balance sheet. For working note, opening balance sheet, and then as and when we run through the question, we will analyze what other things are required. Right. So first there is two balance brought down given. This is nothing but your cash balance. It will appear in the opening balance sheet, 2,50,000. Let's enter it there. See, balance sheet as on 1st April, cash at bank 2,50,000. Then we have subscription received 4,20,000. So since we have the subscription account touch, let's also complete the adjustments. Subscription received is given. We have to take the current year income 4,20,000. So 4,20,000. Subscription include 40,000 received for the year ended on 31st March 2024. Which year are we preparing the accounts for? 31st March 2025. So here we are including 40,000 related to 31st March 2024. Does it belong to current year? No. That means we have to subtract minus 40,000. Then on 31st March 2025, subscriptions due but not received were 25,000. For the current year, this amount belongs to the current year. It is due. So we will have to add 25,000. Advance subscription received for the year ending on 31st March 25 but pertaining to the year 25-26. So there is an advance subscription which does not belong to the current year related to the future period. So this does not include in the current year income. So we will subtract minus 35. The subscription received in advance for the year ended 31st March includes 14,000 pertaining to the year 24-25. You had received subscription for the last year, but that subscription amount belonged to the current year. So what should we do? We need to add it to the current year. So after considering all these adjustments, we get the current year subscription income. 4,20,000 minus 40,000 plus 25,000 minus 35 plus 14,000. So this will be your subscription income. See in the income and expenditure account, 3,84,000. So for this, we will have to write the working note. There I roughly showed you how we are getting this value by taking add subtract, but this need to be presented in the working note. I will just show you how the working note is written. See, either you can write this statement, or if you're comfortable with the subscription ledger, you can also go ahead with that too. Anyway, you get the same values. See, subscription as per receipts and payments, subscription outstanding for 2025 belong to the current year, so we will add this. Likewise, we'll also understand the alternate treatment of this. This is your closing outstanding, so this is in the nature of receivable, so it will appear in your balance sheet. See here in the closing balance sheet, 25,000. Subscription outstanding 25. Likewise, subscription outstanding 2024 will be again your opening asset. So 40,000, that will also be reflected. Subscription received in advance for 2024 belongs to the future year, is your liability. Sorry, subscription received in advance for 2024. That means current year income was received in the previous year. So we will have to add 14,000. So in the opening balance sheet, when you received this as an advance, this would have been your liability. So subscription received in advance 14,000. Then subscription outstanding again in the nature of receivable. So we will not consider this in the current year because this was outstanding for the previous year. So minus, and this also again we will be reflecting this in the opening balance sheet. Likewise, subscription received in advance for 2025 in the closing balance sheet, we will take this as a liability. Add, subtract, why we have done accordingly. I hope you have understood while we discuss this in the top itself. So that will give us 3,84,000, which is taken to the income and expenditure. This will be one of the important working note for subscription. So do it neatly, guys. Reading further. Opening, then we had donation for match fund. See here, there is match fund opening balance given. That means there is a separate fund maintained for it altogether. Here we have to simply apply fund accounting. So opening balance of match fund given 30,000. This is as good as is your liability. So in the opening balance sheet, we will first record this 30,000. See, match fund 30,000. So since they are giving us the details, we will also present this as the working note. So this is discussed. Working note 3, match fund expense to be shown. Because match fund excess anything, we will do the treatments in the balance sheet itself. If there is any excess balance is coming, that will have to be reflected in income and expenditure. So we will first understand what values are given. Match fund opening balances was given to us. So that was 50,000, I guess. Yes. So sorry, that is 30,000. So this match fund opening balance 30,000 is written. Then in the account, we had donation for match fund. This is your receipts. So for match fund, we are receiving donation. That means fund balance will increase. 55,000 we will add. donation for match fund. Donation for match fund, we are adding 55. Clear with this? So now we have just started with the working note. Whenever we come across such items, we will record. Then sale of match tickets. Anyway, we are coming across with the match tickets itself, which where we are making match fund. So this is also connected to this 20,000. This is again your receipts. It will be added. See, proceeds from sale of tickets 20,000. Clear? Then entrance fee. Entrance fee, we will also have to cross check whether there is any adjustment given as such. Entrance fee, see, capitalize 50% of the entrance fee, means 50% will go to balance sheet liabilities and then 50% to the income and expenditure. This is your receipts. So 85,000, 42,500 in the closing balance sheet and 42,500 in the income and expenditure. Observe here, by entrance fee 42,500 and entrance fee 42,500. Clear with this? Both simultaneously covered. Then salaries and wages 1,65,000. So likewise, we will check whether there is any adjustment. There is outstanding salaries and wages, which is 40,000 for the year ended on 31st March 2025. So 1,65,000 plus 40,000 will appear in your income and expenditure account because it is a current year expense. See, 1,65,000 plus 40,000, 2,05,000. So this is your outstanding expense liability appearing in the closing balance sheet. Outstanding salaries 40,000. Then we have taken this and this. Then there is office expenses 35. For this, there is no other adjustments. There is only one more, which is depreciation on sports equipment. Right. So we can directly enter all of these. Office expense 35, telephone charges 28, 35 and 28. Office expense 35, telephone charges 28. Then we have match expenses. Remember, we had maintained one match fund, so we will net off it there. 1,10,000 subtract from these balances. 1,10,000. So match expenses adjusted 1,10,000. Now let's take the total 30,000 plus 55 plus 20 minus 1,10,000. There is 5,000 negative. Now understand one interpretation here. In the fund accounting, we will first consider all the receipts, all the payments in the same fund balance itself. Observe one thing carefully. We are observing the treatments for both balance sheet as well as the income and expenditure. The amount available, all receipts we have considered minus the expense. We will take the complete expenses which has been incurred because that will be impacted in our current year income and expenditure. But in the balance sheet, when there is no balance at all, you cannot show anything in negative. So here the balance will turn out 0 for the match fund. I hope you understood this treatment. Now let's observe how this will be reflected in the books of the accounts. Observe here, match fund, they are writing but showing it as nil because we know why it has turned out 0. Now, in the income and expenditure, we will write two match expenses, which is only 5,000. Observe carefully. We are only writing the excess and not the complete treatment, whatever we have done it in the working note. This point should be very, very clear by all of you. Yes, I hope understood. Reading further. By electricity charges 32,000. Then there is traveling and conveyance 65. We'll come to sports equipment because there is depreciation on that. 32,000 and 65,000. Electricity charges 32, traveling and conveyance 65. Then on the sports equipment, there is depreciation of 25%. So we will charge depreciation 2,15,000 to 25%. So this will also appear in the balance sheet, less depreciation. Clear? Then sports, this is done, done. And then we have the closing balance. So this will be taken to your closing balance sheet, 1,45,000. 1 lakh 45. So all other values entered. So first job here is to close the income and expenditure, find out whether there is surplus or a deficit. In this question, there is deficit. So we will subtract it from the capital. For the capital, first we need to find out the opening capital fund balance. We have entered all of the values. Capital fund will be a balancing figure, that is 2 lakh 46,000. So 2 lakh 46 minus 6,000, your value will again now be 2 lakh 40,000 reflected. Clear with this? Understood the question? So this is how we will total the balance sheet. As you observed, in this case, the question was pretty simpler for not-for-profit organization because the adjustments was also simpler enough. If you had a good practice, this was a must-do question. This completes our question number 4. Both was easy to take up. Yes, let's discuss question number 5. Now, this question will have one as internal choice as well. So, in that there is first BRS and then there is Bills of Exchange chapter question. So, let's first understand the BRS. From the following information supplied by Mr. D, prepare a bank reconciliation statement as on 31st March 25 after amending cash on that date. So the question is clearly specifying that we need to first amend the cash book balance and then take the revised one to prepare BRS. So that means in this question we need to prepare adjusted cash book and then BRS. Clear with this? Yes. So they have given us bank overdraft as per bank statement. As soon as they give you two things, that is to prepare adjusted cash book and bank reconciliation statement, first make a bifurcation. Which transactions will come in adjusted cash book and then bank reconciliation statement. In this one question, what you have to observe is for doing adjusted cash book, we first need the existing cash book balance. That is when we can come across the revised cash book balance. But observe one different thing here. The question is giving us bank overdraft as per bank statement. They are not giving us the cash book balance itself. Fine. Reading further. Checks issued but not presented for payment. This is the timing difference. We would have made the entry in the cash book. So this we will take it in the PRS. Then checks recorded in the bank column of the cash book but not sent to the bank for collection. Remember, we are doing this as on 31st March 25. You have recorded this in the bank column. But if you are not sending to the bank for the collection itself, there is no point of having that entry present there. So we need to reverse it. So therefore, this will go in the adjusted cash book. Then payment received from customers directly by the bank. So bank has already made the entry. No entry is present in the cash book. So we will have to record this in the cash book. Next, bank charges debited in the statement. So again, the entry is made in the passbook, but no entry in the cash book. So this will appear in the cash book. Checks deposited with the bank but not collected. So you have made the entry for the checks deposited. This is again resulting due to timing difference. So therefore, this will appear in bank reconciliation statement. Then a bill for 5,000 discounted with the bank in February, dishonored on 31st March, and noting charges is paid by the bank. There is a bill dishonor along with the noting charges, which is given as 20. The entry is made in the bank statement but not in the cash book. So this will appear in the cash book. Next, premium of life policy of D paid by the bank on his standing advice. So payment entry is made in the bank statement because of the advice given. This is not reflected in the cash book. So we will have to record this in the cash book. Later, overdraft balance credit on 15th March of 14,000 was carried over as a debit balance on the next day in cash book. Observe one thing, it was actually a credit balance which is standing at 14, but you have carried it as debit balance 14, which is not correct. This is due to error. So first of all, this needs to be corrected in the cash book. Now, when you are correcting, remember there is 14,000 debit, but we actually want 14,000 credit. How do we bring that to 14 credit? First 14,000 cancellation for debit and then actual 14,000 on the credit side. The total revised amount, what you take is 14 plus 14, 28. I hope all of you understood how we are getting this 28. First, we need to cancel on the debit side 14,000 and then recredit 14,000 extra. So total will be 28,000. All these entries, we will observe how this will be presented in the cash book as well as in BRS. See, as I mentioned in this question, they are not giving us the cash book balance at all. They are giving us the bank overdraft, which is as per bank statement. So, in the adjusted cash book, we don't have any opening balance. So, we'll just record the entries as such. So first, checks issued but not presented for payment. We will have to first find out the revised value. So let's keep that on hold. Checks recorded in the bank column of the cash book but not sent to the bank for collection. When it is for collection, that means you would have recorded on the receipt side in the cash book. Now, this is not at all present in the business. So we need to cancel this. So where will I reflect? We need to reverse the entry on the payment side, that is on the credit side. So we will enter by checks recorded in the bank column of the cash book 3000. Clear with this? Next. Payment received from customers directly by the bank. So payment is received from the customers. You have not recorded it in the cash book. So this is your receipts. We will record it on the receipt side 6000 customers account. Direct deposit. Clear? Next. Bank charges debited in the statement. So this is the expense. So bank charges debit 40 rupees by bank on the payment side. By bank charges. Then we have checks deposited as a BRS. We will address that later. A bill for 5000 discounted with the bank in February, dishonored on 31st March, and noting charges is paid by the bank. The entry is already done in the bank, but you have to record this in the cash book. The bill is dishonored. When the bill was drawn, the entry would have been bills receivable to debtors. Now it will be reversed, customer or debtors account. So customer's account debit to bank because we have discounted this bill with the bank. So bank will have to be receiving this payment. What will be the total amount? 5000 of the bill value and 20 rupees. So this will be recorded on your payment side by customer for the bill dishonor 5020. How are we getting this? 5000 of the bill value plus 20 rupees as the noting charges. I hope this is understood. Next. Then we have premium of life policy of D paid by the bank on his standing advice. So this is in the nature of your expense. It is already recorded in the bank statement but not in the cash book. Coming on the payment side, premium of life insurance policy 350. Clear? Then there was an error, overdraft balance credit, which was taken as debit balance on the next day in the cash book. This needs to be revised. See, this is an overdraft balance. Therefore, we will reflect it on the payment side. But when we are reflecting, we will have to consider the double amount. By error, overdraft balance carried over as a debit balance 28,000. Clear? After considering all of these entries without opening balance, we will have one closing figure 30,410. This we will take it in the BRS. Overdraft as per cash book. There were two more entries which we decided to appear in the bank reconciliation statement. One, checks issued but not presented for payment. Checks issued means if this is my cash book, if this is my passbook, as soon as the check issued, I would have reduced the balance in cash book. So which book are we supposed to alter? Only cash book, because if they are asking adjusted cash book, that means we can have base book as cash book. So in order to match, I will have to certainly add, since there is overdraft balance here, I will subtract. See here, minus 11,000. Checks issued but not presented. Likewise, next, checks deposited with the bank but not collected. As soon as the check is deposited, you will increase the cash book balance. No entry in the passbook. If I have to match, I will have to bring down the balance. Since this is overdraft, I will reverse. So I will add 9,000. So add checks deposited but not collected. So after considering this, we get 28,410. We started with overdraft balance as per cash book. So we will have to get the balance as per other book. So this is turning into again debit balance. So 30,410 plus 9,000 minus 11,000. So it is 28,410. We will have to get which balance as per passbook? Debit balance as per passbook. Debit balance as per passbook will again mean this is an overdraft balance. If you observe, the same balance was also given in the question. See here, bank overdraft as per bank statement, 20,000. Identically, if I have to see, both balances should have to match. Since the question here is not giving us the cash book balance, since there will be a difference, for which ICAI has also given us the note. See here, they are telling due to missing information in the question. The missing information is all about the cash book balance, which is not given. Because of this, there is a difference. The overdraft balance as per the passbook does not align with the overdraft balance as per the bank statement given in the question. That is why the difference is reflecting. If they had given the cash book balance, hopefully the amount what you are getting after preparing BRS and the given value should have to match. I hope you understood what we are trying to discuss in this particular point. Yes. Moving on to the next part of the question. P owed 2 lakh to Q. On 1st October, P accepted a bill drawn by Q for the due amount for 3 months. Q got the bill discounted with his bank for 1,98,000 on 3rd October. On 31st December, before the due date, P approached Q for renewal of the bill. Q agreed on the conditions that 1 lakh along with interest at 12% per annum for 3 months on the amount of 1 lakh will be paid and P would accept a new bill for 3 months for the balance amount. These arrangements were carried out on 2nd January. However, on 2nd April, before the due date, P became insolvent and only 40% of the amount of the bill could be recovered from his estate. Pass the necessary journal entries with narration in the books of Q. So you are supposed to pass the entries in the books of Q. Let's begin the question. P owed 2 lakh to Q. That means Q will have a receivable. So therefore on 1st October, P accepted a bill drawn by Q for the due amount for 3 months. So what will be the entry for this bill's receivable account debit to P on 1st October? See here, on 1st October, bills receivable to P, the amount will be 2 lakh. Then Q got the bill discounted with his bank for 1,98,000 on 3rd October 2024. So the bill was drawn on 1st October. Immediately on 3rd October, Q got the bill discounted with the bank. So we will first receive the money. Bank account debit, discounting charges account debit to bills receivable. So this will be the entry on 3rd October. Bank account discount to bills receivable. 1,98,000 you're receiving means discount will be 2,000. Then later what happened? On 31st December, before the due date, P approached Q for renewal of the bill. That means here he is approaching for early retirement. Q agreed on the condition that 1 lakh along with interest at 12% per annum for 3 months on the amount of 1 lakh will be paid and P would accept a new bill for 3 months for the balance amount. So on 1st October bill drawn, the actual due date was falling when, if it is for 3 months, October to November, November to December, December to Jan. So on 1st October, 3 days of extra, it would have been 4th of Jan. So on 31st December, P is walking to Q for asking extension. So as per the extension terms, 1 lakh along with interest for 12% for 3 months should be paid immediately and the balance P would accept a new bill for 3 months for the balance amount. This would be the terms and conditions. These arrangements entirely was carried out on 2nd January. 31st December he asked for renewal and this arrangement taking over on 2nd January. First we will reflect the entries for this. On 31st December, when P asked for renewal, there was an immediate settlement of 1 lakh along with interest. So, what will be the entry first? For the renewal, we have to cancel the existing bill because that is going to mature on 4th of January. 31st of December, P account debit to bank account. So, this will be the entry 2 lakh and 2 lakh because the now bill is discounted with the bank. P account debit to bank account. That is why the bank is getting credited here. Being the bill cancelled up to due to P's inability to pay. Then on 2nd January, P is paying interest along with the amount, the balance amount of the bill. So first we will make it due. 1 lakh is the bill amount. 12% is the rate of interest for 3 months into 3 by 12. So this will be 1 lakh into 12% into 3 by 12. So we are first making it due. Interest, you are writing the entries in the books of Q. Interest for you is an income. So we will have to pay P. So what is the due entry? P account debit to interest account for 3,000. Then on the same date, he is paying it along with 1 lakh. So what will be the entry? You're receiving the money, bank account debit to P, 1 lakh plus 3,000. Previously we made it due, now we are receiving. So this was the entry. Then on the same date, he's accepting the bill for the balance amount. So then you're again drawing a new bill. So the entry for that will be bills receivable account debit to P. What is the balance amount? 1 lakh. Because the total amount due was 2 lakh. In that you're already receiving 1 lakh plus interest. I hope this is clear. 1 lakh is the balance. Later, what is happening? On 2nd April, before the due date, P became insolvent and only 40% of the bill which could be recovered from his estate. Now, first of all, whenever there is insolvency, we have to first reverse the entry because there was bill generated. So, what will be the reverse entry? P account debit to bills receivable. The same thing getting reversed. Then 40% of this we will recover. So, the entry will be bank account debit 40, remaining is your bad debt. Bad debt account debit to P account 1 lakh. So this is the ultimate conclusion entry. The entry was structure was simpler. Just be careful with respect to making the interest entry due. Clear with this? Yes. Next. Mr. Sahil runs a factory which produces sugar. Following details are available in respect of his manufacturing activities for the year ended on 31st March. Opening work in progress is given, closing work in progress, then raw materials consumed, closing inventory of raw materials, higher charges, direct wages, factory rent, repairs and maintenance, sugar, sale of scrap, all this is given and they're asking you to prepare manufacturing account for the year ended 31st March. So prepare a manufacturing account format. It will have particulars, units column and then amount column. Likewise, particulars, units, amount. In this question, it is represented in tons. So we are writing it in tons. So to opening work in progress, 15 tons is given 4 lakh 50 and then closing work in progress 3 lakh 60. Will accordingly enter this values. To opening work in progress 4 lakh 50, closing work in progress 3 lakh 50. Then there was raw materials consumed that will appear on the debit side. If you are aware of the manufacturing account format, this is pretty simple, 32 lakh. Then we had closing inventory of raw materials. This would have anyway impacted in my raw material consumed. So again, you will not separately make any entry. Higher charges of machine at 200 per ton produced. First, how much we produced? 500 tons were produced. 200 per ton is taken. So 200 into 500 will be your higher charges. Higher charges on machine 200 into 500. Then we have factory rent. Okay, we have direct wages contracted at 400 per ton manufactured and 200 per ton of closing WIP. So we had manufactured 500 tons, 500 into 400. Then we have 200 closing WIP here is 12 tons. So 500 into 400 and 200 into 12. See here 500 into 400, 200 into 12. So this will be 2,02,400 which will be entered as direct wages. Clear? Next will be factory rent, repairs and maintenance of plant 2 lakh 40, 1 lakh 50. Then write sale of scrap on the credit side. See here factory rent 2 lakh 40 and then we have repairs and maintenance, sale of scrap on the credit side. After entering all of these values, you have to just close the trading account. The balancing figure will go to trading account in the name of cost of finished goods. So that is 38,98,400. The question was pretty simpler if you are aware of the manufacturing account format. Next. Alpha Limited has an authorized equity share capital of 20 lakhs divided into equity shares of 100 each and 10% redeemable cumulative preference shares of 5 lakh divided into 100 per share. The paid up equity capital. See, authorized capital is anyway not so important. The paid up equity capital is of 13 lakh 50 and 10% redeemable cumulative preference shares of 100 each of 3 lakh. Paid up values are given. Balances in other accounts are securities premium as 35, P&L 80,000, general reserve 4 lakh. The company has investments of the face value 40,000 being carried in the books at a cost of 45,000. The company has decided to redeem the cumulative preference shares at 10% premium, partly by making an issue of equity shares of the face value of rupees 1,50,000 at a premium of 10%, and then investments are sold at 110% of their face value. Investments was there, they are giving two values, one was 40 and one was 45. This is getting sold at 110% of the face value. All preference shareholders have been paid off except two shareholders having 500 shares. You are required to pass the necessary journal entries for effecting the above transactions, and working note should form part of your answer. So this is about redemption of preference shares. So let's understand the entries. The redemption is happening first partly by making issue of equity shares. This equity shares are issued at a premium of 10%. And then by selling the investments 110% of the face value. So 40,000, if I have to take 110%, 44,000, 4,000 profit is made. So first let's understand the entries for all of this. See, first of all, we are making the preference redemption due. The number of preference shares value was worth 3 lakh. So this is redeemed at 10% premium. So what will be the due entry? 10% cumulative redemption redeemable preference share capital, which is 3 lakh. Premium on redemption of preference shares, 10% on this will be 30,000. Preference shareholders, 3 lakh 30,000. We have first made it due. See, being the amount payable on redemption of 3,000 preference shares transferred to shareholders account. This premium, which needs to be written off at the end of the year, profit and loss to premium on redemption. You can also pass this entry at the end as well, 30,000. Clear with this? Now, this redemption is sourced through issue of equity shares and then by selling investments. Understand one thing, there is section 55 which does not allow any money to be utilized other than by issue of equity shares, and the balance should be done using creation of capital redemption reserve. For this, let's understand the working note. The amount which is required from capital redemption purpose is 3 lakh. Remember, we will only take it on the face value. 3 lakh is the amount required. Now, from the issue of equity shares, how much we are able to get? Here also understand one thing. From the issue of equity shares, since that is happening at premium, we cannot use the premium amount for redemption. We will also again only take the face value there. So 1,50,000 was what is received as on face value because 10% extra on this was premium. So 3 lakh was the amount required for redemption. 1,50,000 is from the issue of equity shares. Balance will be done by the balance transferring from capital redemption reserve. This should be clear. So for all of this, let's understand the working note. First, for issuing equity shares. Bank account debit to equity share application. How much money we are receiving? 1,50,000 is the face value. On that 10%, that is 1,65,000. So this will be 1,50,000 plus 1,50,000 into 10%. This is 1,65,000. Then transferring this to share capital, equity share capital to share, equity share application to equity share capital to securities premium. This will be transferred at face value and 10% 15,000 on that premium. Clear with this? This is at face value. Then we have the balance by creating capital redemption reserve. We have the balances available in general reserve, which was given to us in the question. So general reserve account debit, what was the general reserve balance? General reserve was anyway had 4 lakh. So we need only 1,50,000. So the entry would be general reserve account debit to capital redemption reserve, 1,50,000. Clear with this? Now we also sold the investment. Investment was present in the business at face value 40,000. You are getting 44,000 in return. So what will be the entry? Bank account debit 44. Investment was shown at 45 because you're recording it at 45. Profit and losses 1,000. Remember, the sale value is calculated on the face value proportion, but what is the actual price at which the investment is getting reflected? 45. So the entry will be bank account debit with the what amount you're receiving. Profit and loss account to investment. At the end, we have done all the entries. Now we will have to pay to the preference shareholders. Preference shareholders account debit to bank. How much you had made it due? 3,30,000. So that will be settled. 2,75,000, 2,75,000. 3,30,000 was due. That was representing how many shares? 3,000 shares. The question clearly told that they are not paying for 500 shares who was represented by two shareholders. So out of 3,000, if the face value was 10 rupees, they are not paying for 500 shareholders. Means the balance left is 2,500. For these 2,500 into 100 plus 10% premium. So that will be 2,75,000. So 2,500 into 11. If I have to be more specific, this will be 2,75,000. This will be 2,500 into 110 because the face value is 100 rupees and premium is 10 rupees. Just to be more specific, face value is rupees 100, premium is rupees 10. Since they have not paid for 500 shareholders, only 2,500 shareholders would be paid. Hence, this will be the amount. I hope this is clear to all of you. Next, last question. ABC Limited has issued 1,20,000 equity shares of 10 each at a premium of rupees 2 per share for public subscription payable as follows. On application 2 rupees, on allotment 5 including premium. If I have to break this, 2 rupees was the premium, so 3 plus 2. Then on first call 2 rupees and on second and final call 3 rupees per share. Application has been received for 1,80,000 shares. So what was the issue for 1,20,000 shares? But you have received excess application. Allotment has been made on pro rata to the applicants for 1,44,000 shares. The remaining applicants being refused. T to whom 4,800 shares has been allotted failed to pay the allotment and first call money and his shares have been forfeited. After the second and final call has been made, N to whom 6,000 shares were allotted has also failed to pay the two calls. There was first call and second call. His shares have also been forfeited. Subsequently, out of these forfeited shares, 7,800 shares, including all shares of T, were reissued to P as fully paid up at rupees 8 per share. Show the necessary journal entries and entries in cash book. So this is the catch. You have to show the normal entries along with the entries in cash book. So there is a transaction starting from issue and then there is forfeiture because of non-payment of one shareholder for allotment and call and for the other shareholders who's not paying two calls as well. Then there is reissue later on. So let's understand this entry. Observe such question comes for a good weightage for 15 marks. First of all, what is the entry? When the application money is received, bank account debit to equity share application. Yes or no? So bank account debit to equity share application. How many applications have we received? We have received 1,80,000 applications at rupees 2 per share. So they have asked us to prepare cash book. So what we have to record now is all the cash book entries will be presented in the cash book and those in the journal other than cash entries will be written in the normal journal. So we have written here cash book format and then the journal format. So here observe. Bank account debit to equity share application is your first entry. So this will be written as to equity share application 360. How much we are getting? How are we getting this? 1,80,000 is the number of application received at 2 rupees per share. Clear with this? Next entry is transferring this to share capital. Now, if you observe how much shares were issued, only 1,20,000. So that much only you can transfer to share capital. What is the entry? Equity share application account debit to equity share capital. 1,20,000 at 2 rupees, 2,40,000. I hope this entry is clear. But for the receipt of application money, we have got this at 3,60,000. We will understand the treatment for that as well. Yes, first entry all of you would have understood. Equity share application money transferred to share capital. Now observe one thing. The company was only issuing 1,20,000 shares, but due to pro rata, they have started issuing, means they have allotted 1,44,000 shares. But you had received the excess application number worth 1,80,000 shares. So in this, first we will have to observe the question carefully. See here, the remaining applications is being refused. So first let's find out how much is the remaining application. Number of applications received is 1,80,000. You have been allotted for 1,44,000. So the remaining application is nothing but 36,000. This is being refused. That means you are refunding the money. 2 rupees was the application money. What will be the entry? Equity share application account debit to bank account. So since we are preparing the cash book bank column, by equity share application, number of applications which are being refused is 36,000 at 2 rupees, so that will be 72,000. So how are we getting this 36? 1,80,000, which was the number of application received, minus 1,44,000 which was allotted. Clear with this? So this entry is done. So now extra amount what was there in the equity share application was how much? 3,60,000. I have transferred 2,40,000. So remaining was 1,20,000. I hope all of you are understanding this. In this 1,20,000, I've already redeemed. I've already refunded 72,000. So how much is remaining? 48,000. So this will be used towards allotment. Adjustment made towards allotment. Clear with this? So what will be the allotment due entry first? Equity share allotment account debit to equity share capital to securities premium, because there is premium on allotment. So how many number of shares? 1,20,000 shares. So 1,20,000 shares into 5. Then this will go at face value 1,20,000 into 3 and 1,20,000 premium at rupees 2. Clear with this? Now we are supposed to receive the allotment money. What will be the entry for this? See here, they have just shown the entries, including non-bank transaction. Let me write the entry here. Bank account debit. Remember, you had some amount where you can, in the application, which we can adjust in the allotment. So equity share application account debit. Then there was a person who's not paying allotment, for which we will represent them as calls in arrears, debit to equity share allotment. Equity share allotment was 6 lakh. You still had 48,000 balance, so we will take it here 48,000. Calls in arrears. There was one shareholder who didn't pay the call money, T, to whom 400 shares has been allotted. Now understand this carefully. 400 shares has been allotted, failed to pay the allotment and first call money, and his shares have been forfeited. We cannot directly enter the values here, 4,800 shares at allotment money. Reason being, this is the number of shares allotted. Whereas we also have the picture of number of shares applied. We will clearly understand this in the working note. See, first we need to understand he has not been paying allotment money, but he has been paid the application money, yes or no? So, if he was allotted 4,800 shares, that means don't you think he had applied something extra? Because there is pro rata allotment done. So, when he had applied for extra, there was some excess application money involved in this portion as well. Yes or no? So now we are going to touch upon that figure. We have the details of 4,800 shares allotted. Now I want how many number of shares was applied for. How do I find this out? 1,20,000 was the number of shares which was allotted. 1,44,000 shares was applied for. So 4,800 if it is allotted, how much is applied for? How do I find this? 4,800 into 1,44,000 divided by 1,20,000. So if I solve this, I get 5,760 shares. So application money was 2 rupees per share. So the application money paid by T would have been 11,520. I hope you are understanding this step, what it is, correct? Now this T did not pay the allotment money. Anyway, he had paid an extra money. The number of shares which he applied for was 5,760. So 5,760 minus 4,800, 960 extra application money is what is paid. Yes or no? So 960 into 2, that is 1920. I can set this off with his allotment proportion due. Yes or no? So first let's find out how much is his allotment due. 400 is the number of shares which he is allotted for. 5 rupees is the allotment money including premium. So this will be 24,000. In this, he has extra money how much? So he had applied for 5,760 shares, but he got 4,800 shares. So what is the extra? 5,760 minus 4,800, 960 shares. So 960 shares into 2 rupees, I can still set it off here. Yes or no towards the allotment? That's what I did. 1,920. So remaining is not what you are getting. So that becomes your calls in arrears, 22,080. I hope this entry all of you understood. So this is what will be reflected in our journal entry, 22,080. So the remaining amount goes to bank. This will be 6 lakh, 5 lakh 29,920. This will be reflected in the bank as 2 equity share allotment. Observe here all of you. 2 equity share allotment, 5,29,920. This is the working. Clear? So, since there are only bank entries reflected here, the balance will be reflected in the journal. These two will be reflected here. Equity share application debit, calls in arrears debit to equity share allotment with the total value 70,080. Clear with this? So, this 3 entries are done. Next, we have first call. So, all extra application money was received, adjusted towards allotment, refund. All those entries done. Next, we have to make first call due. What was the number of shares? 1,20,000 shares. What is the first call money? 2 rupees per share. So equity share first call account debit to share capital. That will be 1,20,000 shares at 2 rupees. That will be 2,40,000. What will be the next entry? Bank account debit. Let me write the next entry here. Bank account debit to equity share first call. But there is one shareholder who's not paying the call money, so that will be transferred to calls in arrears account debit to equity share first call. First call amount was 2,40,000. Shareholder holding how many shares? And to whom 6,000 shares were allotted. Also failed to pay the 2 calls. So again 6,000 shares were allotted. 2,40,000 was the share first call money. Remember, there was two shareholders. That was one which is N holding 6,000 shares, not paying 2 calls. But also there was T who did not pay from the allotment money itself. His part of the money is also involved here. So total number of shares who was not paying first call will be 10,800. How am I getting 6,000 for N and 4,800 coming from the T? So 10,800 into call money is 2 rupees. So that will be 21,600. So 2,40,000 minus 21,600. 2,18,400 will be reflected in the cash book. Observe here. To equity share first call 2,18,400. Yes. After this, we have final call money to make it due and then receipt. But before that, observe one important thing in the question. See here, the question clearly specifies that T to whom 4,000 shares have been allotted, 4,800 shares have been allotted, failed to pay the allotment and first call and his shares have been forfeited. So what does this mean? Immediately after making the first call, his shares have been forfeited. So before we make the second call due, we have to first make the forfeiture of this 4,800 shares. So what will be the forfeiture entry? Equity share capital account debit. Securities premium will also be debited. Why? Because there was no premium money collected on the allotment since he didn't pay the allotment money. So securities premium account debit and then to calls in arrears with respect to the amount being transferred from the allotment and then first call to share forfeiture account. So equity share capital, you had 2 rupees of application money and then 3 rupees of allotment and then 2 rupees of first call. So totally 7 rupees per share capital. Securities premium was 2 rupees. So 4,000 share, 800 shares into 2. To calls in arrears to share for feature. Now understand carefully how are we getting that value. 22,080 is coming from the allotment, and there was call included for which that was also not paid. So that is, how are we getting this? 22,080 plus 4,800 shares into 2 rupees. So that is nothing but 31,680. 4,800 into 2 plus 22,080 will give me 31,680. And then the balance will go to share forfeiture. I hope all of you understood this entry. Now after this, we will make the final call due. Observe one thing, 1,20,000 was the total number of shares which was issued. In that, 4,800 shares have been already cancelled. So we will receive or make final call due only on the remaining share. How much is the remaining share? 1,20,000 minus 4,800. So that will be 1,15,200 shares. We will make it due only on this shares. Observe, and this is very important to consider. So what will be the due entry? Equity share final call to equity share capital 1,15,200 at 3 rupees per share, because the final call money was 3. Now this amount has to be received. In this 6,000 worth, shareholder is not paying the amount. So 6,000 into 3 rupees will be your calls in arrears. What will be the entry for that? Bank account debit, calls in arrears account debit to equity share final call account. Equity share final call will be 3,45,600. 6,000 shares did not pay the call money. So 6,000 into 3 will be transferred to your calls in arrears, 18,000. So balance will go to bank, 327,600. So this will be reflected in the cash book. Bank to equity share final call 327,600. Observe here all of you. To equity share final call 327,600. I hope this is understood. Next. So this entry will be passed. Calls in arrears account debit to equity share final call. This is the entry for this. Now after this share is again getting forfeited. So the entry will be equity share capital. All money is being called. So 6,000 at 10 rupees. Calls and arrears were transferred 18,000. So remember, there was also a call money included here. 6,000 into 2 and then 6,000 into 18. That is how we are getting 30,000. This one. 6,000 into 2 plus 6,000 into 3. This is how we are getting 30,000. First call and final call. That will be transferred to share forfeiture. After this, there is an reissue. The reissue number of shares is 7,800 at 2 rupees. That means the entry for this would be, for reissue, bank account debit, share forfeiture account debit to share capital account. This will be the reissue entry. 7,800 shares have been reissued. 7,800 into 10, 78,000. You are reissuing it at 8 rupees. So this will be 62,400. And the balance will go to share forfeiture. So this will be reflected again in the cash book to share capital 62,400. See here, to equity share capital 62,400. This completes all our entries, so we can close the cash book and find out the balancing figure. Closing balance 14,26,320. So this is done. So the remaining entry share forfeiture to share capital, that is 15,600. Last one entry is the amount to be transferred to capital reserve. Here again there is a consideration which needs to be made clearly. See here, out of this 7,800 shares, include all of the shares of T. T was holding how much? 4,800 shares. So for this again we will also observe the important calculation. Simple reason being, here we have number of shares allotted, but we also have to do it as per the basis on number of shares applied for. See, forfeited amount on 4,800 shares is 11,520. How are we getting that? Which is nothing but your 5,760 shares at 2 rupees. This is lying in the forfeited balance. Correct? Next, forfeited amount on 3,000 shares, because 7,000 share and 800 shares was reissued. We are completely using 4,800 shares represented by T, and the balance is 3,000. Now this 3,000 is from total number of shares, which is 6,000. 6,000 was his number of shares. In that I'm only using 3,000. How much is the balance lying in the forfeiture amount? Remember, from the calls in arrears, we had 30,000. So that will go reflected in the balance in share forfeiture. So we're taking it on the proportionate basis. Out of 6,000, how much is it for 3,000? So 15,000. 26,520 is the balance available. So from the reissue, 7,800 into 2, I am issuing this at discount. So that is the loss to be set off. 15,600. The balance will be 10,920, which is nothing but the amount to be transferred to capital reserve. Now, if you analyze this, why should we do such a calculation instead of not reflecting like we normally do with the per share value? In this question, as we have observed, we are taking this on the pro rata working. We are taking the number of shares allotted based on the money available from the excess application money. So that is why we have to follow this particular structure of solving. So I hope you understood how we are getting 10,920. So this is being transferred to capital reserve at the end. Forfeited shares account debit to capital reserve. So if you observe, this was one good question which definitely requires a practice before you observe this in the final paper. There is one similar question like this in your study material. Make sure you practice all of them in order to not miss. Where students can go wrong majoritarily here is, before making the final call, they might completely miss out on passing the forfeiture entry. This is again a new set of question being framed. So this becomes a must to do for practice before you appear for your respective attempts, guys. Done. So there is one more last question. Let's quickly complete that. Next, at the time of valuing inventory as on 31st March, a sum of 7,500 was written off on a particular item. Okay, before that, there are some more points. From the following particulars, ascertain the value of inventories as on 31st March 2025. Inventory as on 1st April 2024 is given. Purchases, manufacturing expenses, selling expense, administrative, financial expense, sales, all these are available. At the time of valuing inventory as on 31st March, a sum of 7,500 was written off on a particular item, remaining in the balance which was originally purchased for 70 and was sold during the year for 65,000. Barring the transaction relating to this item, the gross profit earned during the year was 20% on sales. So this is just an extra item. Previous year's balance was written off. The previous year's balance was 70,000, from which 7,500 was written off. Now, if we roughly calculate 7,000 minus 7,500, 62,500 is the actual value which is getting sold for 65,000. So, what is the profit on this? This will be 2,500. Clear with this? Now, excluding all of these transactions, every other sale was generating a profit of 20%. Done. Next, on 15th March 2025, the goods of the sale value of 20,000 included in the above sales were sent on sale or return basis to a customer. The period of approval being 4 weeks. He returned 40% of the goods on 10th April 2025, approving the rest. Now, first of all, when the goods are sent on sale or return basis, it is not at all a concluded sale. This is sent on 15th March and you are calculating the value of inventory as on 31st March. So, this what we are telling, goods of this sale value 20,000 is included in the above sales. Now, the question here is it an actual sale? No. Since we discussed that goods sent on sale or return basis is not a concluded sale. So, this should not be part of your sale. So, what is the treatment? You will have to subtract this from your sales. Next, he returned 40% of the goods on 10th April. This is irrelevant for me because I am finding out the value of closing stock as on 31st of March. And what is happening beyond that, the calculation will not at all be impacted. So only simple treatment from this is we have to reduce 20,000. Clear? So this question we can solve using a format of cost of goods sold, and then cost of goods available for sale. So let's structure wise what is the cost of goods available for sale. So here only let me do the working. Available for sale. So this will include all of your items, inventory, that is opening stock, plus purchases, plus your direct expenses, which includes your manufacturing expenses here. So this will be 176,900 plus 964 plus 1,90,000, 13,30,900. All other things will not be part of your direct expense. So this will not come, this will not come, and even this will not come. Sales is 15,37,000. So in 15,37,000, I have to make two bifurcation because the value of 65,000 which is getting sold is not at generating profit of 20%. So I will take out this 65,000, and then what is remaining? 1537 minus 65, 14 lakh 72,000. In this 14 lakh 72,000, 20,000 should also be not included because this is not part of your sale. We already understood this. So minus 20,000 if I do, 14 lakh 52,000 is my normal sales where the gross profit is 20%. Yes, cost of goods available for sale is arrived. So cost of goods sold. This is nothing but sales minus gross profit. On 65,000 sales, my profit was 2,500. So this will be 62,500. Then on remaining at 20%, that was 14,52,000 minus 20%. 14,52,000 minus 20% will be 11,61,600. Add up both 62,500. So this will be 12,24,100. 13,30,900 minus 12,24,100. 1,06,800. This will be my closing stock. Now just for your reference, let's check the ICAI solution. Yes, 1,06,800 is my closing stock. See here, Institute has considered here itself the abnormal item. You can also do this way, not a problem at all. So they have taken this as in the cost of abnormal item as well. So this format is also working. We have also solved in the same format, but we have just bifurcated into cost of goods available for sale and cost of goods sold. Let me bring that solution below this. So while I share, it will be easier for your references. So you can simultaneously cross-check and observe how this is being solved by the institute. Both gives us the same answer. Whichever format you have understood, you can stick on to that. Clear with this? So this completes our solving of September 2025 question paper, guys. A good set of questions for practice. I am sure those of you have seen it for the first time would have definitely felt it difficult since there were many tricky points involved in different set of questions spread over. This definitely required a good set of practice. I am sure the upcoming aspirants will look at this and mold carefully for the next papers which would have been set up in the next level. So let's give our best effort in every time you spend with your books or with the lectures, guys. Stay or maintain that consistency that will definitely build you with lot of confidence, which is what is ultimately required to face any exam, guys. You are doing your best. Keep rocking and all the best. Until I see you in the next video, take care. Bye.